Just a button. I think it's working now. Yeah? Okay, great. Let's take it from the top again. Good evening, everyone. How are you all doing today? I don't mind. Warm up, yeah? All right, welcome to the 3rd Annual Moneycontrol Mutual Fund Summit. Now, Moneycontrol, being deeply immersed in India's financial ecosystem, has always had a finger on the pulse of the market, understanding the opportunities and pain points alike. Now, for 3 years now, the Moneycontrol Mutual Fund Summit has brought together the best and the brightest minds in the mutual fund industry together to explore and address concerns and developments that have been key to the growth of this vital industry. Now, tonight, we are joined by the top minds in the industry as we navigate the future of India's investment landscape and the crucial role mutual fund industry plays in empowering the financial journey for the millions of Indian investors. Now, the Indian mutual fund industry, fun fact over there, has grown from 10.06 trillion as of 31st of July 2014 to a staggering 67 trillion as of 31st of July 2024. That's more than 6-fold increase in a span of just 10 years. According to the recent report, the industry AUM is expected to hit a remarkable 100 trillion by 2030. But while these numbers sound impressive at the first glance, as people sitting in this room no doubt already know that this is just tip of the iceberg. Now, the mutual fund penetration in India is only 15% of the GDP so far. And this is far below the global average as well of 74%, which indicates massive scope of growth, which is why this conversation, the one which we'll have here tonight, is so important and so crucial. Now, this evening is about how SIPs are empowering Bharat. Tonight, let's deep dive into the SIP and mutual fund phenomena that is mobilizing India's rising savings into instruments that are easy to understand and navigate, even for novice investors. Now, we will explore subjects that are vital to India's mutual fund success story, and also industry veterans and experts will have their opinions on it. Tonight, we will also honor the key drivers in this vital growth story. Now, the mutual fund distributors. Now, this is the first time that the Mutual Fund Distributors Awards will be held. This evening, we will declare excellence, innovation, and high performing amongst those who have been architects of India's wealth. Now, making the awards possible for us here have been our knowledge partners like K-Fintech, our esteemed jury comprising of industry stalwarts like Vishwanathan Anand. He's the head of sales, UTI Asset Management Company Private Limited. Sugata Chatterjee, Chief Business Officer, Nippon India Mutual Fund. We also have Senti J, CFA, CAIA, Chief Business Development Officer at K-Fintech, Praveen Shankar, Chief Operating Officer, K-Fintech, and we also have Gladstone Somerville, Head of Distribution Services, also from K-Fintech. We thank you all and all of you for joining us today, and also for your invaluable time and efforts in letting us give them a platform. So a huge round of applause for all of them as well. We'd also like to thank our partners tonight for this event. Presenting partner, ICICI Prudential Mutual Fund, co-presented partner Motilal Oswal Mutual Fund, and the event partners HSBC Mutual Fund and DSP Mutual Fund. And now, to begin the evening, I'd like to call upon stage Nalin Mehta, Managing Editor, Moneycontrol, for his opening address. Nalin.
Thanks very much, Sonal. Is the mic working? Thanks very much, Sonal. So, on behalf of Moneycontrol, absolutely delighted to welcome you all to the Mutual Fund Summit. We at Moneycontrol are great believers in the India story and the great expansion of the Indian markets and of Indian capital, in the rise of a new kind of retail investor at the center of this growth. and the centrality of the mutual fund industry in this massive transformation. As India's largest business and market digital news platform, we at Moneycontrol chronicle the daily ebbs and flows of the industry. We also critique it at times. We provide a pivotal platform to provide perspective on the industry. And as part of that effort, this is our third mutual fund summit. And this edition, we are particularly proud to host some of the leading lights of the industry, the CEOs, fund managers, various key stakeholders, to debate, discuss, and answer some of the questions that animate it at this moment in time. We also are delighted to honor and award some of the biggest change makers and some of the biggest change makers in the industry. So, in the last 3 years, the SIP inflows have tripled in size. And as that happens, how does one handle the big shift in the nature of the Indian investor, the growing number of first-time investors, and the big social shift with investors more and more coming from smaller towns and outside of the bigger cities? What will it take to sustain this level of growth, to do it responsibly and sustainably, and also what will it take to ignite the next big leap? These are some of the questions we hope to kind of debate and talk about today. We are particularly honored to welcome our chief guest, Mr. Amarjeet Singh, a whole-time member at SEBI. Also, our special guest who will be joining us later this evening, Mr. Vishwanathan Anand, who's shouldered a large part of the Indian dream for many years. We have an action-packed evening lined up for us ahead. We hope this is the beginning of a nuanced conversation of the big issues facing the industry, and we hope that we answer as many questions today as the questions we raise. Thanks very much. Have a great evening.
All right, thank you, Nalin, for those opening remarks. And Nalin's remarks have clearly set the tone for what we are in line for, what we are expecting from today evening. But the key driver really for the mutual fund adoption in the retail investors is confidence, right? And through this regulatory measure, focus on investor protection, simplification of investment processes as well, and long-term policy initiatives which have been looked into. Now, SEBI has significantly contributed to the growth of mutual fund in India by instilling that confidence amongst investors, making mutual funds a preferred investment choice as well. And who we have next is somebody who will shed more light on that. Mr. Amarjeet Singh, whole-time member at SEBI, has been a key contributor to this story. In his 30 years career at SEBI, he has been instrumental in bringing about various primary market reforms, including the introduction of UPI as a payment mechanism in IPOs, a reduction in lock-in period of minimum promoter holding in public issues, revamping the rights issues process to reduce the listing period, and much, much more. And without any further ado, let me invite Mr. Amarjeet Singh to the stage to take you through the evening and get started with our keynote address.
Thank you for that kind introduction, and good afternoon, everybody. It's a pleasure to be a part of this event, and I'd like to thank Moneycontrol for inviting me to this third mutual fund summit. Frankly, I didn't have much idea about what Moneycontrol does in the space of mutual funds. But ever since Kaizad reached out to me a couple of months back, I have learned about the contribution this platform is making in the space of mutual funds. So let me start with a rear view, if I can say, on a rather trite note. The Indian securities market have come a long way, and looking back, when I joined SEBI, this was about 30 years back, our market cap at that point of time, it was only BSE listed companies. It was INR 3.4 trillion, and today it is INR 458 trillion. Sensex was a mere 3,700 odd at the end of March 2014, and today it is over 80,000. At the end of March 1993, there were 9 mutual funds, including UTI, with an AUM of INR 470 billion, and today there are 45 mutual funds with an AUM of INR 65 trillion plus. So we have indeed come a long way. SEBI's mandate, when I started working, was the same as it is today. Three verbs, 3 very impactful, powerful verbs: develop, regulate, and protect. And all of you are familiar with this, so I don't need to elaborate that. But going back again, I'm tempted to look back, 1990s, when SEBI was focused a lot on first generation fundamental transformational reforms in the markets. And mutual fund, even then, was a very critical piece. The underlying objective was that mutual funds can be an important vehicle for spreading the equity culture in our country beyond Mumbai. See, the markets have been conventionally concentrated more in the western part of the country and mainly Mumbai. So how do you take the equity culture across the breadth and length of our big country? So mutual funds was clearly recognized as a very important vehicle at that point of time. 3 decades later, as I stand before you today, as part of my professional journey, it is very gratifying, even personally, professionally, organizationally, to see that objective of using mutual funds as a vehicle for spreading the equity cult in the country fructifying. Both industry and regulators have worked together for decades for this moment. So mutual funds are now, as we all know, an integral part of the investment landscape and have a key role in channelizing more savings into investments through securities markets. So against this backdrop, Kaizad gave me the liberty. He said, you can speak as much as you want, but I'll not bore you for a long time. I'll try to be brief. So I will divide my remarks in 3 parts. One part I'm sure most of you are very familiar with, the key trends, and I would highlight more opportunities, the way we see it, what are the opportunities in the landscape. That is part 1. And second piece, which I would like to talk in some detail, some issues and challenges which we see are very relevant for an orderly and a responsible growth of the industry. See, regulators are known to raise red flags, spoil party. That's not my intention, but it is my duty, while we are celebrating the success of our mutual fund industry, we should be mindful of the issues and challenges that we face. And I would like to spend more time on that. And I'll wind up with very briefly, some recent initiatives that we are taking for further market development. So let me come to the first strand straight away in terms of the key trends and what are the opportunities. Again, a lot of it is no news for you. You all know it. But just to set the context, AUM of the industry has increased to an unprecedented high of INR 65 trillion as on July 31, 2024, at a CAGR of over 21% in the past 5 years. If you look at the geographical mix, the share of AUM from B30 cities, beyond 30 cities, as a percentage of total AUM, it has increased from 15% to 18% in the past 5 years. We are witnessing greater individual participation between March 2020 and June 2024. the number of unique investors in mutual funds has increased from 2.9 crores to 4.7 crores. Again, an impressive CAGR of almost 12%. And SIP, this has become part of our vocabulary. And I remember until 5-7 years ago, we had to explain what SIP is and what it does and so on. So such a huge transition, SIP needs it's so compelling actually. It needs no description as to what it is and what it is doing to our markets. In the month of July 2024, SIP contribution was over INR 233 billion, 23,000 odd crores. Again, an increase of over 2.8 times in the past 5 years. So this could be interpreted as a reflection on, some sort of a beginning of a shift in country's investment culture, if I can say, from recurring deposits to a more effective wealth creation tool. Let me talk about the opportunities, 2 opportunities, the way we see it. One is that while we've come a long way, and let me also note what are the main reasons which have contributed to this fantastic growth. Increase in digital penetration, ease of onboarding, ease of investing, greater investor awareness. These are some of the main factors that have facilitated the fantastic growth. However, there is still a good runway in the coming years and ample scope for increase in penetration. So further penetration is one opportunity which we all need to take note of. And there are certain data points which support that. While the industry is expanding its reach beyond the major cities, over 52% of the industry AUM still comes from the top 5 cities alone: Mumbai, Delhi, Bengaluru, Pune and Kolkata. The number of unique investors in mutual funds is a fraction of the roughly 55 crore PAN card holders those who have linked their PAN card to Aadhaar. So these numbers are reflective of the immense opportunity for mutual funds to further tap into savings across the demographics and regions. Efficient and effective use of the amount set aside from the schemes for investor awareness and education initiatives can help mutual funds in this direction, in this endeavor. The next opportunity which mutual funds AMCs have is the stewardship opportunity. If you look at the impact of the mutual fund growth story on our ownership of Indian listed companies, so you see a very interesting trend there also. The ownership landscape is changing. In the past decade, the shareholding of mutual funds in listed companies has seen a remarkable increase of over 2.5 times, from 3.37% at the end of March 2014 to 8.95% at the end of March 2024. As a whole, the ownership of domestic institutional investors has increased to almost 15% in 2024 from around 10% a decade ago. And correspondingly, and very interesting, the share ownership in listed companies by FPIs is showing a declining trend. So DIIs are playing a strong counterbalancing role as against FPIs. Now, this rising ownership trend places mutual funds in a position to play an active role in ensuring better corporate governance of listed companies. Voting data for Nifty 500 companies shows that the highest dissent by institutional investors were related to ESOPs, slump sales, sale of substantial undertakings, related party transactions, director appointment, and remunerations. This reflects that a number of institutional investors now focus on compensation, capital allocation, and transparency, which is a good sign. SEBI has also been actively encouraging mutual funds to discharge their stewardship responsibilities, and we are willing to explore how to make this stewardship role of mutual funds more effective. We already have a code for stewardship. We have 6 principles, but can we make it better? Going forward, I believe mutual funds, through their voice and through their voting and through their engagement, they can play a significant role in driving better corporate governance practices. And see, we need good governance, good corporate governance in all spheres in our market. Now let me come to the second part of my address. And as I said, I'll like to spend a little more time on that because those are the issues which are not so much talked about while we celebrate the success story. So first is, let me straight away, elephant in the room sort of, governance of AMCs. So in order to sustain, that's my personal view, the current growth story, it is essential for the mutual fund industry to uphold strong governance practices and maintain a reputation for integrity and reliability. Good governance assumes greater significance given the significant retail participation in mutual funds. Retail investors comprise over 52% of AUM of equity-oriented schemes and over 28% of industry AUM. And mind you, many of these new investors, many of these retail investors, the numbers which I spelled out, many of them are the first-time investors. So it's very important to maintain their trust in the markets, their trust in the investments that they are doing. And you know, I've spent 3 decades and I've seen once the trust of the investors is lost, it is very difficult to get back the same investors in the market. We just slide by a good number of years. So SEBI has also taken several policy measures for strengthening governance and oversight of mutual funds, including mandating the constitution of audit committee of AMCs. We've also mandated the constitution of a unit holder protection committee. It directly resonates with our investor protection objective by the board of AMCs with a focus on unit holders protection, including adoption of healthy practices in terms of sales, advertisement, investor awareness, etc. The second piece in the issues and challenges, the self-regulation by industry. Again, a very important aspect. So we believe self-regulation is an important, and it is connected with the first point. It is a very important component of good governance. The AMC board and trustees are relatively closer to the affairs of the AMC than we as a regulator are. Therefore, they are better positioned to identify and address instances of malpractice or misconduct swiftly and more effectively. In this context, considering some front-running instances in the past, we have recently mandated AMCs to implement a structured institutional mechanism. I'll explain what it is. It's like 3 big words, which can proactively identify. This mechanism's objective is that this mechanism should help the AMCs to proactively identify and deter instances of potential market abuse, including front-running and fraudulent transactions in securities. This mechanism shall consist of enhanced surveillance systems, internal control procedures, escalation processes, and a whistleblower policy. The standards for implementation of such an institutional mechanism have been collaboratively developed by AMCs and MFI in consultation with SEBI. In fact, only yesterday, MFI has issued the standards on structured institutional mechanism. So the idea is this mechanism will help us have a consistent, uniform practices across AMCs in terms of their internal monitoring. So let's see how it plays out going forward. This is a very recent step that we've taken. Let me also very briefly flag some important observations which are made by SEBI during our inspections or during our supervision of AMCs, and I just picked some important ones. There are numerous things that we come across, but I thought it may be a good idea to share some important areas for AMCs to take note of. So first is ensuring, this is sort of not a laundry list, but a list of 5-6 points. So I'll just take you through that. Ensuring segregation of activities of mutual funds with that of portfolio management and other advisory services. So we've come across instances where it was not done, and that's not appropriate. Implementation of dealing room related requirements and dealing room related access controls. Having a robust stress testing policy. Following ethical practices when it comes to selling of mutual fund schemes, such that malpractices such as indirect passbacks, payout to distributors or investors, payment of access commission through vouchers or gift cards do not take place. Ensuring compliance with guidelines for trading in securities by employees of the AMCs. Let me also mention in this context that with effect from November 1 this year, 2024, units of mutual fund schemes shall be under the ambit of SEBI insider trading regulations. Proper maintenance of record to show due diligence and trail for investment decisions. It's very important to have these kind of trails because sometimes, God forbid, if the investment becomes controversial, you have some trail, some evidence of due diligence done. Let me move to the next point under the same head, issues and challenges. Let me talk a little bit about monitoring and supervision by SEBI. Again, I picked up this because this is again not much talked about. We have a very comprehensive strategy now and toolkit for undertaking monitoring and supervision of mutual funds. Our conventional way has been to visit AMC's office once in a year, pick up the AMC based on a risk-based criteria, and then do inspection. That has been our way of doing it for a number of years, but few things which are of more recent development. And we also conduct thematic inspections. We pick up a theme and run it across various AMCs. So in recent years, we have been increasingly deploying technology in our supervisory process to automate compliance checks. The broader intent is to enhance a culture of continuous compliance. Technology has enabled us to monitor thousands of data points, which are impossible to monitor manually. We've developed an algorithm-based alert monitoring system that is used to check regulatory compliance. As on date, over 100 algos are used to monitor various regulatory requirements. Additionally, we also have alerts to detect potential malpractices such as mis-selling, churning, continuous rollover of short-term deposits, etc. So this technology-driven supervision is helping us in many ways. First and foremost, it has substantially increased our supervisory bandwidth and brought greater focus on supervision. It is helping us to reduce the potential blind spots, the potential risks which may be building up in the system and which need to be detected early. It is helping us to reduce the time between the occurrence of an event and detection. If you detect an event too late, there's a lot of potential for greater harm. But if you detect in time, you can minimize the harm, you can minimize the damage. In addition to supervision, the data that we collect as a part of our supervisory endeavor, we also use that data extensively while undertaking policy measures. We backtest our policies on the data that we gather. Just two more points on the issues. And I think this is also very important. I was debating whether I should say this first or the other things which I already spoke. So as the industry is growing, and this is about the infrastructure, the sufficient and robust infrastructure. We need to ensure, as an industry, as a regulator, that the infrastructure and ecosystem is robust enough to handle greater volume of transactions. Maintaining sufficient capacity and scaling it up in tune with the growth that we are witnessing is obviously very critical. We recently had a situation, many of you would know, where there was a substantial surge in transactions in mutual fund units, especially subscriptions. I think there was a fall in the market on a particular day and people wanted to get the benefit of a lower NAV on that particular day, and there was a rush for subscriptions. But some of the AMCs were unable to allot the same day's NAV to investors. So in the context of, so the point I made earlier, it's very important to have the appropriate capacity, which has to be very proactively monitored while the growth is happening. Are your systems good enough to handle the growth that you are witnessing? So in the context of robust infrastructure, having a sound framework for management of operational risk is critical. Maintaining sufficient disaster recovery and business continuity, cybersecurity, data privacy, these are some other issues which need to be kept in the forefront. These are the areas where there is a need for greater focus and oversight by the AMC board, supported through technology committee. The last point, and very important again, and this has been talked about earlier as well. So while we are witnessing a lot of money coming into the mutual fund space, we need more listings, we need more asset class, we need more fundraising by existing listed companies from the market so that the money which is coming in can be appropriately invested in various avenues. So the fresh paper issuance is clearly a better reflection of fresh capital formation and raises less doubts about asset price inflation. So this is another very important piece. Let me come to the third part in terms of the recent policy initiatives, and I'll be very brief there because these are some of the initiatives which are still work in progress. So I'll just very briefly mention about them. We've issued a consultation paper. The comment period is over on the introduction of a new asset class that seeks to provide investors with a regulated, it would be high risk, if I can say, or maybe it's relatively more risky product, featuring higher risk-taking capabilities and a higher ticket size. The new asset class is aimed at bridging the gap between mutual funds and portfolio management services and curbing and another important objective here is curbing the proliferation of unregistered and unauthorized investment products. Because otherwise there is a temptation for people to get into the unregulated space. So that was another driver for coming up with this idea. We've recently concluded consultation on introduction of MF Lite regulations for passive funds. The proposed low-ticket SIP is another exciting prospect for furthering financial inclusion and also the growth of the industry. And lastly, we've also concluded consultation on allowing greater flexibility in participation by mutual funds in credit default swaps, CDS. Let me conclude. I firmly believe that as far as development and regulation of mutual funds industry in India is concerned, the industry has openly embraced change and we have a powerful narrative to share with the world. However, we do have a long way to go. There is no room for complacency. Maintaining public trust and confidence in the integrity of the mutual fund industry through good governance, which I outlined earlier, right conduct, transparency, and innovation will be key to future growth of the industry. And I firmly believe as long as we remain focused on these aspects, I'm sure that the mutual fund industry of the future will be a beacon for the rest of the securities markets and asset management industry, not just in India, but globally. Thank you very much for your attention.
Thank you so much, Mr. Singh, for those incredible insights. And now it's time to sort of move on to our first panel discussion. Now we're exploring the theme today of investor expectations. As we all know, India has a diverse pool of investors, and there are implicit expectations of strong performance and risk management, in addition to transparency, ethical practices, and timely disclosures. Price sensitivity also goes hand in hand, and India's investment consciousness grows. And as a result of the AMCs themselves raising the bar on customer experience, investor expectations have also evolved to include much more. Investor education, investor strategies, financial planning, the omni-channel customer service, and even personalized offerings. Now we'll be bringing you this, and the topic that we have picked up today, or the headline, as they say, that we've picked up today is, are mutual funds geared to meet investor expectations? Are AMCs geared up to take care of the new investors? Let's take it up with our panel, and please join me in welcoming them on stage. First up, we've got Radhika Gupta, MD CEO, Edelweiss Asset Management; Swaroop Mohanty, VC CEO, Mire Asset Management Managers India; Kalpen Parikh, MD and CEO, DSP Mutual Fund; and finally we have Ajit Dayal, founder and advisor of Quantum Advisors. And to moderate this, we've got our very own Kaizad Dajania, Assistant Executive Editor, Personal Finance, Moneycontrol. Come on guys, we can do better than this, yeah?
Hello, good evening, and welcome to Moneycontrol Mutual Fund Summit. This is the third edition of our Moneycontrol Mutual Fund Summit. I'm sure many of you all would have been here with us when we launched the first edition of our Mutual Fund Summit. Swaroop, you were there. Radhika, Kalpen, you were also there. We launched this summit, the first edition, in December 2022. And I still remember the tagline that we gave that year was from 40 trillion AUM to 100 trillion AUM. And I still remember when we gave that tagline, there were a few doubts internally expressed as to whether the 100 trillion figure that we're talking about, or we're projecting the industry to be hitting in a few years' time from then on, would be realistic or not. And I think you just need to understand the mutual fund industry, to be there in the industry, to observe whether from inside or outside, to understand the momentum that the industry had already started at that time. That was December 2022, 40 trillion. Today, we are sitting in August 2024, and the industry size is already 65 trillion. So we're well on the way the industry is on achieving the 100 trillion target. And the big story in this journey is the evolution and the emergence of the retail investor. And that can be seen in the SIP inflows that the industry has been getting. Last month in July, the industry clocked around 23,000 crore worth of inflows in mutual funds through SIPs. We believe that day is not far away when the industry will get 50,000 crore worth of inflows in mutual funds through SIPs. Now, of course, the industry has done a lot of good things, thanks to AMFI, thanks to industry players, all under the watchful eyes of SEBI. But one thing that we are all cognizant about is that in this journey, we are going to be getting a lot of investors, not just a lot of investors, but a lot of first-time investors, a lot of young investors, a lot of investors who haven't seen a bear market before. So is the industry equipped and mature enough to handle these young first-time investors who've never seen the bear market to make sure that they don't leave the industry with a bad experience? That's the question that we'd be asking today on this panel as well as our other two panels following. So Radhika, let me start by asking you, easy question, a big picture question. Very briefly, two challenges that you see. I mean, of course, there are a lot of opportunities, but two big challenges that you see from this journey of 23,000 crore SIP to 50,000 crore SIP.
So first, Kezad and the entire Moneycontrol team, congrats on this summit. I think you started a tad bit late because I heard that there were supposed to be 250 people in the room and there are far more than that. So I think in 3 years, the success of the summit is incredible to see. It's also a little tip-off to the popularity of mutual funds. So perhaps some of us can take credit. And I hope the rooms get larger as you do that. Two challenges that you asked me to talk about. So I'll narrow in on two things. I think in the last couple of years, there has been a lot of talk of so much liquidity coming into the markets. People are almost surprised at the size of this 23,000 crores, the number of young investors, all of this. And before I say challenges, I would say, one, we should not be surprised. In fact, Amarjeet sir, when we were talking, we were talking about this whole noise on bank deposits and MF, and he said, finally, this is an outcome that one day we wanted. We wanted the mutual fund industry to compete with traditional instruments, and we should take some amount of pride in that. So this is good liquidity. And I do believe that this is just the beginning, because mutual funds and equities are still 8% of household savings. They've gone from 4 to 8, so we should feel happy. But the US is at 45, and it took a couple of generations. But that is the trajectory.
In our lifetime, will we see mutual funds becoming a dominant part of financial savings?
I think in our lifetime, there are reasonably young people here. I think we will see India have a 1 lakh crore per month SIP book. And I tell a lot of MFDs this. Now, two challenges. One is, I think, the kind of money, and I'm sure you will talk about it, knowing you, the kind of money that is channelized. So someone asked me off the record, are you worried about money coming into mid and small cap funds? I said, I don't want to target that, but I am worried that 40-50% of the new money comes into thematic funds. I've been a big advocate of a dal chawal school of investing. And I do think we are veering too much towards pickle and papad and chutney, because all of us have lived this cookie enough. We know that for people to make money, they need to stay invested, and they need to stay invested for a really long time. And investing in pickle and chutney doesn't do really well. So I think that's one. I think the second is we need to, and I know a lot of MFD friends are sitting here, a lot more continuous effort needs to be done to create more ARN holders. India has about 1 lakh plus ARN holders today. I think the country needs about 10 lakh ARN holders to take the mutual fund story to all parts of India and Bharat. You can do sachetization, you can do everything, but finally you need a lot more people to tell that story.
So fleet on the street.
Fleet, army on the street.
Army on the street, and you're saying money coming into, let's say,
the right things.
The right kind of products.
Dal chawal and army on the street.
Okay. Swaroop, you've hearing from the street, getting feedback from your team and speaking with distributors. When so much of money is coming right now at these levels, at Sensex, at where it is right now, so much of money is coming, so much of new investors are coming. What's your estimation? I mean, do people know that where they are investing the money? Do people know that, understand that, markets can go up as well as markets can go down? Are they prepared for a market crash if and when that happens?
Kazad, first of all, thank you so much for inviting me to such a wonderful event as usual. Let me define this so much money. In the last 1 year, and let's stick to equity at this moment, and I'm giving some data, the industry AUM has gone up by 10.8 lakh crores. Net sales is less than 30% of that, just 2.8. That means 28% is too much money coming. 70% is market appreciation. That's reality, right? So when you define too much money, it's actually market appreciation more than sales. When you look at the 27%, bulk of it, 40% till last 2 years was small cap. And now we are seeing thematic, right? One is we talk about asset allocation, and I firmly believe asset allocation happens only in social media. In real life, it is brash return chasing that is happening. Data says it. I mean, Neil's there, so Neil's probably one of those beneficiaries of that 27% not having a small cap. We don't have a small cap, so we are part of the 70% of market appreciation in our growth. That's the truth. The net sales, thanks to some NFOs in the last 2 months, have actually gone ahead of the SIP book of the industry. That's the truth. So let's redefine this big money. Actually, big money is missed in probably one of the best performing markets of the month. And with passives now moving from 2% to 16, 18% of folios in the market, I'm not talking about AUMs, actually index buying is also going up. So that's where is the big challenge that we are talking about. When we talk about mutual funds and the challenges or the infrastructure are two fronts. One is the fund management challenge, or building a good fund management infrastructure. And the other part, I think, is which Mr. Singh pointed out, is building a good infrastructure at the back end to see that money comes in and goes out very, very efficiently. If we can build this two part, because the market is expanding. I mean, when SEBI introduced the market cap linked categorization, I think between the smallest large cap and now to the 4-time increase, right, in market cap. While new stocks are coming, the market is expanding. My personal opinion was we could have done a lot more in the amount of money that could have come in. The average age of investors coming in is declining by the day. And my personal opinion is they're finding other avenues to invest rather than mutual funds is a reality. We just went to a fintech show this last weekend. I think there were more people in the Bitcoin and the derivatives stalls than in the mutual fund stalls. This is where the money is going. So we have to really think.
That bit has been sorted a little bit because of that.
I hope it gets sorted. I think it's great to see the regulator addressing it a bit. But I think in markets which people feel 25, 26% given by large cap funds as bad returns, then we have to do a lot of thinking.
My worry, Swaroop, is that when investors are investing now, when fresh investors, young investors are already coming into the markets, they are coming on the basis of past returns, they are coming on the basis of trends. So do they understand?
Guys, all of us, when we started as return chasers. As we grow, and Kalpen will bear with me in this because I'm getting into his zone, is that slowly we realize that it's a business of mitigating your risk. In the last 2 years, it suggests that it's just return chasing and risk has gone out of the window. More often than not, I hear investors telling my risk profile has gone up. When I ask them, give me 2-3 instances why your risk profile has gone up, nobody has an answer for it. But time will tell. We've learned the hard way, so probably this will go through that same process.
So suppose if, God forbid, if the markets were to crash, we're talking about 23,000 crore to 50,000 crore SIP, but the SIPs can also dry up, the SIPs can also go down. Is the industry prepared for that?
No, I think let me put some things on this. I think regulatory-wise, we are more than prepared on this. And I'm not saying that because Mr. Singh is sitting here. I'm being very categorical here. The safeguard or the guardrails of the industry, and that's most important, right, are in place. And that makes this industry a far comfortable and safeguarded
from a confidence point
from a perspective. How we manage the money is our job. That's our job. And I think over the years of managing money for 20, 30 years, the fund management is up to it. That I have no doubt on that.
Kalpen, just wanted to go a little deep into, since we've started thematic funds and sector funds. We were just looking at the trend of NFOs, the NFO deluge which has been happening in the industry. So we were just looking at some numbers. On an average, the industry has launched about 105 NFOs every calendar year since 2021, 21, 22, 23, and even 2024. We're still in August and we've already launched 112 NFOs. This is the total NFOs. Now, that's one figure. I'm giving you another figure. the collection of NFOs have been between 30,000 crore to 80,000 crore each in these calendar years. That's another second figure. And the third figure, the share of thematic and sector funds, absolutely astounding. In 2021, there were about 24 NFOs, which was about 24% of the overall NFO pie was in sector funds, thematic funds. Today, it has gone up to 59%. The collections in thematic and sector funds have also gone quite up. So why are fund houses launching sector funds and thematic? I mean, I'm not asking about you personally, but about the industry, if you can give us an insight as to at these market levels, why are fund houses launching so many sector funds and thematic funds? Is it only because SEBI has given you a leeway to launch N number of sector funds and thematic funds and only one fund per category, or is there more merit to it?
I think all of us, if you see, the mood is very heady. We are chest thumping. And we are only celebrating size. So if the environment is incentivizing size celebration, I think everyone is responding to that. That's my first comment. You asked why thematic funds. I think it's all interlinked. I don't think investor is buying a thematic fund or he's buying a sector fund. The investor is buying returns of the past in the belief that they are his returns. The returns of the past belong to someone who invested in the past. But I think as an ecosystem, we all have to reflect that we all start with returns. So when, let's say, you will also compare funds, it will start with returns. When media will compare funds, it will start with returns. When we talk about a new idea, I will show that, see the track record, this idea has returns. So I think right from the birth, the only variable which has been taught to the investor is returns. So it's very unfair at times to say that the investor is chasing returns. But what else have we shown to him? Except for returns. That's my first comment. Why is the industry doing it? And I'm a part of that industry, and we are also doing thematic funds. But today we are launching the Nifty top 10 largest stock index fund, which is what has not performed at all. So we are launching a fund today which has earned 1/3 of the rest of the market, because we believe that's relatively safer. So there are different strategies different people are using. Some are launching funds which they believe where the trends will continue. Some are launching funds which believe that the mean reversion will happen. We launched a banking fund 3-4 months back. We are not that happy because we collected only 400 crores and the returns have not come. So I think different strategies in different markets. And yeah, as you rightly said, the thematic category is very liberally open. So it allows for launching of more funds. So I think what sir mentioned some time back, the role of responsibility and transparency and good conduct, is a huge opportunity to highlight to our investors that if this is the theme we are launching, what is the likely risk for this theme? Because themes will always have risk. I was delighted when one of you, covered. We had launched a thematic old fund offer 4 years back of our infrastructure fund. It used to get me less than 1% of flows. The same theme today is very popular, where 9 subsections of that are coming out as an NFO. And today we are getting 20% in that fund. It's an old fund. It's a 20-year-old fund. So I think the important point is we need to highlight that markets have cycles. And, cycles means this too shall pass. In good times, we have to constantly remind ourselves and our investors this too shall pass. Be prepared for that. Likewise, in bad times, we have to remind that this too shall pass. Another interesting data point to add to what Radhika and Sarup mentioned. As of today, this whole SIP boom, 23,000 crores is the number we celebrate. But the net number is 8,000 crores. Why is no one writing about it? So we need to be conscious of that there are enough people who are also booking profits perhaps, or their SIPs are stopping and maybe, either they are rolling or not rolling out. And of this 23,000 crores, 3% of flows have come to hybrid funds. In today's environment, probably hybrid funds are the best products, multi-asset allocation funds or any hybrid fund, which is a balanced bouquet of, asset classes. But only 3% is going into hybrid funds. So I think, it's human beings finally, evolution has taught us to choose funds basis past returns. It is a mammoth task to explain to investors that returns have cycles, returns will fluctuate. So moderate expectations.
But when the launches are happening, like our distributors and advisor friends tell us that on the side, fund houses tell distributors and advisors to be cautious when they sell their funds to investors, but on the other side, fund houses keep launching sector funds and thematic funds. So shouldn't it be your responsibility also as an industry to collectively...
So I can comment on my responsibility as DSP. We have learned that, if you launch funds at peak of cycle, generally experience is bad. And if you launch funds at low end of cycle, experience is better. In last 8 years, every fund launch of ours is governed by one question: will I put my money in it or not? Will I put my mother's money in it or not? Will I put my chairman's money in it or not? And if the answer is yes, we'll launch a fund. If the answer is no, we'll not launch the fund. I can comment about DSP. Unfair on my part to comment about anyone else. And the challenge is, when we launch a fund in a low cycle, I'll collect 400 crores. I'll not get any headline that this fund collected 400 crores. I think the opportunity is to... So it's great that this question is being asked, but I think everyone has, their own antennas to take a call, what I want to do. So if a distributor is telling you that a fund is telling me sell NFO and then telling me don't sell NFO because it's overheated, he knows what he should do. See, we are claiming that the retail investor is not wise, but ultimately we have to take a call what is right to do, what is not right to do. Lastly, Morgan Housel has written a very powerful tweet today morning that, investing is 1 unit of data multiplied by 10 units of stories in bull markets. In bear markets, it's the other way around. So in bull markets, everything gets magnified with stories. So themes can, get magnified as stories. I was meeting someone the other day in the afternoon. He said that, there's a huge capex cycle which is going to happen. So we should make money. But how many people know that a lot of that gets priced in? And how many people know that capex cycles also will have cycles? It's a cycle, capex cycle. It's not secular. So I think we all are talking right questions. You're asking the right questions at the first level. There's a great opportunity now to go deeper. And the power is collectively in our hands to ask tough questions. You ask us questions that what can go wrong with your themes? So I think that's a great question to ask whenever an NFO is out, or whenever a headline is written for a product, or whenever a product presentation is released. Who should not invest? What should be time horizons? What is the past history? So when we relaunched our Tiger Fund, we highlighted that the infrastructure category since 2008, when India was supposed to overtake China till today, has delivered 4% CAGR return. The category of funds. So hot theme. So all I'm saying is that, at least I can claim, our intent is to launch cold themes. We don't launch hot themes. Okay. We launch cold themes.
Okay.
Kezad, can I make a request to you? I'm sure the others will agree. Since every year you ask us about return chasing, can you guys in media stop publishing the last 1 year return statistic? It is the statistic that does the most danger to investors. And I'm sure all of these guys are very responsible guys. Publish 5-year returns. Publish rolling returns, which in my view, if I had to pick one stat to evaluate a fund personally, it would be 5 or 7-year rolling returns. Please don't rank funds on 1-year returns. We are creating what I call the sorting investor. He goes to a website, he sorts funds on 1-year return. And even if the fund says Radhika is a nice person fund and it's delivered 80% return, he or she will invest. So please, as members of the media, take that pledge not to publish 1-year returns. It will do.
Also the fintech distributors, fintech websites also, they haven't, we'll get to that also.
आप शुरुआत करिए, बाकी सब follow करेंगे.
Okay, Ajit, you've been quiet for some time, so let's bring you in now. I want to take you back to your early days. And since we're talking about NFOs, since we're talking about thematic funds and sector funds, I remember your famous comment that the asset management industry is an asset gatherer rather than an asset manager. Do you still hold on to your thought?
Yeah, thank you for inviting me here. I think that, I remember, I'll go back a bit in history when Mr. Singh said that he's been working with SEBI for 30 years. I remember in 1988-89 when Dr. Dave was made the designated chairperson of SEBI, he set up a 4-person team to help create the mutual fund rules. And I was part of that 4-person team sitting in the IDBI towers in Nariman Point way back when. And I remember when we were writing the rules, we're talking about the net worth of what an AMC should have. And when the AMC net worth rules were announced, first 3 crores and 5 crores and 10 crores, and now became a big 50 crores and hopefully not 100 crores one day. it seemed to be, from a SEBI perspective, that large is good and small is bad. So you must have high net worth to be in the business. And I think the asset gathering industry has more than reciprocated that thought. What I hear and what I read all the time, and that's why I don't get invited to many places to speak, is that when you look at what's happening in the industry, it's about finding the product that is hot that will get you the AUM, as opposed to what makes sense for the investor in the long run. And I think if you looked at it from an investor's perspective, if you have 6, 7, 8 mutual funds on the equity side, that's all you need. Provided you've explained to an investor, and you've correctly mentioned, Radhika, that the press must play its role in terms of ensuring that people look at the 5-year rolling return or 3-year rolling returns number, not 1 year sort of, numbers which make no sense at all. But if you look at it from the investor side, there's such a FOMO, like a fear factor of missing out on this market boom, as opposed to getting the investor to realize their goals, recognize the risks that they want to take. Risks come first, returns come next. What we are talking about on stage and everywhere else has been about the returns of the industry. And I keep on asking, what is the risk? So at Quantum, for sure, I know we look at risk first. Then we decide, if you want this much of risk, what return can you get? And once you know your risk, you know your return. Here, what's happening in this whole return scenario of rolling returns, 1-year returns, and launching of funds, you're out there just getting AUM for the sake of getting AUM. Because like I said, if most investors need 6 to 8 funds, and we have 500, 600 funds out there, it doesn't make any sense at all. The other thing in terms of asset gathering is look at the small caps. We did a study of small caps. We will release it. It'll be a bit explosive, I guess, but we haven't yet. If you look at the top 5 small cap funds in India, it's absolutely frightening. Look at what their number of stocks were in 2020, 2021, 2022, 2023, and now. And look at the AUM growth and see what we call style drift. Just from the number of stocks, many of these funds had 50, 60 shares in the portfolio when they were small AUM and they were small cap. And they built a track record. And based upon that 1-year track record number that we just heard, they started being sold these funds or started buying these funds for the return. Today, some of these funds have 100 to 200 stocks in them. They become the index. There's no chance they can outperform the index because there's a cost, there's an expense ratio, and you have to underperform the index. That shows the asset gathering mentality. Everything in life has a capacity. This room has a capacity. This bottle of water has a capacity. A mutual fund has a capacity. I've been requesting from SEBI for a long time that they should force every fund to declare its capacity. And what do I mean by that? What I gave the example of small cap funds, that after a particular size of AUM, you're not going to get the same track record that you purchased because you're going to behave differently as a fund manager. From having 50, 60 stocks, you're now going to have 200 stocks. We did a capacity study on the top 5 funds, and we found that one of them would have to reduce its AUM by nearly 95% to go back to its core thesis of what the fund was when it was smaller.
So Ajit, looking at that, listening to your response on that question, I just wanted to highlight a few themes. Now, put your fund manager hat on, and manufacturing fund, innovation. 7 new funds were launched in manufacturing. 5 new innovation funds were launched. 13 new banking and financial services funds. There's a defense fund also. Auto funds, 4 auto funds were launched last year. So aside from the fact that so many NFOs are being launched, especially in thematic sector funds, can you just briefly tell us as to what is the longevity of these kind of themes? I mean, are they all weather, as in, do they have sustainability?
So, launching thematic funds, from my experience, managing money globally, managing money in India has been a non-starter. You're not going to win because you're buying a cycle. And unless you're very smart and you time that cycle of that sector, As you mentioned, you buy it when it's cold and you sell when it's hot. The question is, will you be advised? Will you as distributors and financial advisors, will you advise your client at that point in time to sell when it's hot? And how do you know that it's hot? Because the fund manager is still saying it's a good place to be in. So I think thematic funds and these sort of funds to me are completely no-no. Total no-no, in my opinion. And I'll go back to one more point, which is the liquidity. We talk about the net asset value. The definition of net asset value is, if I redeem, I should be able to get that. So if the share price, if the NAV is 100, when I give that redemption at 2 o'clock, 3 o'clock, I should get 100 back. But if many, many people redeem on a particular day, and there's a run on the fund, if you will, at the end of that day, particularly for small cap funds, there's a very high probability that the NAV will be sharply lower. Some of these small cap funds that we've analyzed in their top 10 holdings, it'll take them 3,000 days of trading to exit a top 10 position. There are 220 trading days in a year on average. That's nearly 15 years to exit a top 10 position. And the average for these funds is between 80 days to 100 days. So I know that SEBI has come out with a liquidity criteria, and this is to ensure that investors, advisors, distributors recognize and let their investors know that NAV may not actually be the NAV they get. And for those of you all who were around in September 2008, please recall what happened to small cap, mid and mid cap funds. There were very few small cap, mid cap funds in 2008, but their NAVs fell by 60 to 70% in a few weeks. Go back in history, look at the charts.
The big warning signs from Ajit. Swaroop, I want to bring you in on, and you and Radhika probably, on this, the other emerging trend, which is seen between this journey of 23,000 crore or 50,000 crore SIP inflows. When we are talking about SIP, now there's more talk coming in the industry about micro SIPs. Of course, people invest 5,000, 10,000 rupees every month in SIP, but now there's a call for investing small size SIPs, sachetized SIPs, 500 rupee SIPs, 700 rupees SIPs, which is fine. But what is the longevity in your, I mean, you've been in this industry for so long, and I'm sure you would have seen patterns of people coming in and coming out, going away. What is the longevity really for people who invest just 500 rupees, 700 rupees SIP? Would they ever see a big gain in their portfolios to be there for the longer term? Is there anyone to advise them? Because most of these people come through online channels where there is hardly anyone to explain them to stay invested in the long run. So flip side of these sachetized SIPs which are being talked about,
See,
how can they be made better?
Kaizad, at a macro level, let me make a statement, okay? I firmly believe that we are a room full of long-term investors now, 10, 15 years in the industry, making extremely short-term investments. That's data. Nobody is there for more than 2 years is reality. Whether it's through the SIP route or lump sum to khatam hai bazaar mein. Because people are now using SIP as a timing tool. While SIP is a cash flow solution, right? If you don't have money per month, you invest. But the moment you convert a lump sum into an SIP, you are timing the market, nothing else, right? STP is a timing tool, right? Nothing wrong, nothing right. But when you look at the data, and Kalpen kind of referred to that 23,000 coming and bank data 8,500, though I believe some data is wrong in that, because when my personal opinion, I have no data to refute it, is that if a redemption happens in an SIP, the entire SIP amount is getting, otherwise 12, 13,000 stoppage is a little, keeping that aside. Fact is, there are enough SIP stoppages happening, and that will happen. See, I'll give a very small example. For the last 2 years, 3 years, none of those NFOs have come from our side because we don't believe in those areas. We've highlighted some of the valuations in the market. In the 70s, when Gavaskar was facing those fearsome 4 bowlers, he was asked what is the best way of facing the quadrat. He said from the non-striker's end. And we're playing the last 2 years practically from the non-strikers end. Ball is swinging dramatically. We've not agreed with it. And since there's a market valuation growth, we've grown with it, right? But since we don't have a small cap, our SIP book has not grown, is a reality. So if you are going to accumulate a volatile asset in your portfolio, the redemptions are bound to happen. That's what is happening at this moment. Little crack, there'll be a stoppage.
But micro SIPs,
Coming to your micro SIP, I'm all for sashaying anything. But we have to think investing 250 rupees in today's economy, kitna gain hoega? 500 रुपये में हो जाएगा, क्या फर्क पड़ने वाला है उसके life में? While our job is to provide avenues of investing, it's up to the distributors and the investors to make a meaningful investment. Today, it's a reality that a person does not need to justify why he or she wants to buy a new phone in the second year, but starting a 5,000 rupees SIP needs a lot of discussion, rolling returns, 1 year return, all that comes. So, till the need of investment is not risen, I'm all for opening it up, no issues, we should be giving, but we have to think, if you invest 250 rupees and it becomes 750 rupees, what meaningful change is going to happen to a person's life? Is where we come from. Is that an asset allocation, or is that really the need of the person's investment is where you have to come from. So opening this up, making 100 rupees, although we have not done it, 100 rupees minimum application size are avenues for investing. If it makes a meaningful change to the person's life, one should, but you have to think twice.
Radhika, there's also the problem of cost. We were checking the costs of setting up an SIP, uploading the KYC documents, registering KYC, everything has a cost. Do micro SIPs really work from a cost perspective also? I mean, Swaroop has said that it's okay to open up, but unless we launch meaningful products and there's somebody to handhold the investor, the 500 rupee or 200 rupee SIP won't grow too much.
So let me give you my two-part take on this. Today, many fund houses, including us, already have platforms that say you can do 100 rupee SIP, 250 rupee SIP. I don't know if some guys, I think someone did a 10 rupee kind of thing also. Now, the reason people don't promote it enough is because costs are prohibitive. Between RTA cost, NSDL cost, and all the lamba chitta of cost, nobody may, and if that SIP is lasting less than 2 years, God forbid, as Swaroop has said, nobody is making money on a 100 rupee SIP. So the reason I am excited about the micro SIP initiative and, the fact that it's being pushed is it will finally focus us to reassess variable costs of doing business in the MF industry. This has been one of my sayings for the last 3-4 years that, an increasing amount of us, margins are coming down, by the way. We are a newer asset management player. Everyone knows equity fund margins now are 40-50 basis points at max if you don't do NFOs. If you don't do NFOs, then Swaroop is raising eyes, and then I am not saying we don't. So if you don't do NFOs and you are a reasonable person, usse zyada margin hota nahi hai, right? But I don't think RTA costs, custody costs, anything has come down. I run the largest debt passive book in the country. I think we make management fees of 7-8 bips. The RTA fee is probably 2-3 basis points. So the reason I'm excited about this is it will call for an entire cost review of the AMC ecosystem, which is very, very good. I think costs of doing business are very, very high. The second point that I would add to what Swaroop made is, I don't know, you already have, I read a statistic, 50 crore Indians that pay 100 rupees a month to Netflix or Amazon Prime. I'm assuming they can already do a 100 rupee SIP. I'm not sure if they need to make it lower, right? Because if a consumer can pay 100 rupees to Netflix, I'm sure he can give 100 rupees to Edelweiss Mutual Fund or Mirae Mutual Fund or whatever it is. The other thing you have to think is, so if with this micro SIP, you are catering to a consumer that is just about able to invest 100 rupees, what is the financial literacy of that consumer? Now, if that consumer is coming via your direct platforms, then they are the sorting investor who's picking the highest funds and then is going to go into thematic funds. That, in my view, is extremely disastrous for that consumer. Or you have an advisory infrastructure that can cater to that kind of consumer. So my worry is, are you ready to service a consumer with that kind of financial literacy?
Kalpin, we are running out of time, so I just have 2 more rounds of questioning to go. First round to you. This other concept of, when we are talking about investors coming in through SIPs, investors coming in through mutual funds, zero folios. That's something which is there in legacy fund houses such as yours. People who may have invested in your funds and then withdrawn, may have gone elsewhere. So is there any effort being done in the industry to get these investors back into the fold very quickly?
Sure. Yes, of course. We all keep writing back to our investors. So, as many investors we have with live folios, we have as many with zero folios. And this is precisely every 3-4 years investors come in and get out. So we keep writing to them. We write to them, we miss you, we love you, please come back. But email open rates are very low. And the only means of talking to them is via existing distributors who keep doing that, or those who are in direct plans write to them via emails. But generally the hit rates are not, the best. And again, I think there's a huge opportunity. I was telling my team in the afternoon that we have to write to provoke him to come back.
How many of them do come back?
Our ratio is around 8% come back. But by the time they come back, some of the existing ones also leave. So I think it's like a train where people come in and go out. And that's an opportunity to write to them in a way to say, पहली बार में 2 साल के लिए मत आओ, 20 साल के लिए आओ.
Okay. Ajit and Swarup, I want to move to you all for the last section, this thing about risk and about internal mechanisms to sort of, safeguard investors from any accidents that could happen. So one, Ajit, give us a sense of how much fund houses invest in strengthening the risk departments. I mean, when you hire fund managers are always celebrated, sales and marketing officials. We were looking at the salary levels of some of these, fund houses, public disclosure, obviously. Only in some of these fund houses did I see a chief risk officer's salary being among the top echelons of the people who are earning salaries. And in some of the fund houses, I did not see the chief risk officer's salaries. Does that mean that fund houses are not investing enough or empowering risk officers to basically ask questions or, hiring people of that caliber? What are fund houses are doing in...
Well, quantum is different, I guess, from the breed in many ways, because I think in our perspective, risk starts with the fund manager himself or herself asking questions about the stock they're about to buy and the company they're buying into and the governance issues that come around that. What you're talking and what we have is a chief risk officer who looks at the risk of the enterprise, right? What will happen if money flows out, you get redemptions, costs go up, SEBI rules change. We look at that risk. We don't look at... So volatility, the up and down movement of a share price is not risk in our opinion. In our opinion, as fund managers at the parent company Quantum Advisors, PMS, and Quantum AMC, risk is buying into badly governed in firms. Some of you may know we filed a case against ICICI Bank recently. In fact, we got a judgment today, and apparently we've lost. I've not read the judgment. But basically, we did that because we believed that ICICI Bank was taking over its listed subsidiary at a price that was too cheap. And we did not want to go to court, but they wanted to ram it through NCLT, so we put our foot in the door and started fighting on behalf of our unit owners, and all costs of the legal come to the AMC. So that's again an issue with the SEBI thing. But so there, the risk was that ICICI has changed after the change of management in 2019. That was the assessment of risk. And what actually happened is that we believe actually it's still risky. So there's an enterprise risk, which is different from the risk to our portfolio. And we recognize we made a mistake. We wanted to stop it. So far, the courts have ruled against us. Let's see what happens. But we think of the ICICI case as a complete breakdown of governance across the spectrum. And if you ask me the biggest risk for India, it's not mutual fund. A mutual fund is a phenomenal vehicle. The question is what happens to those who are controlling the mutual funds? Are they really looking after the investor's interest? Or are they looking after their own interests as asset gatherers? And goes to the trustees, the proxy agencies. I mean, the whole spectrum is to be questioned, in my opinion. But I'll write a book on that one day. Thank you.
Okay. Swarup, last question to you. Sir spoke about, the setting up the internal mechanism to be able to catch mischief, front running, etc., etc. When we privately speak to fund managers or fund houses or CEOs of fund houses, they say, of course, these systems must be set up. The problem is getting the right caliber of people to be able to identify and catch these trends, to be able to monitor effectively. Is there enough happening over there? Do you get enough talent to be able to set up your internal processes. Will this be a success, the internal mechanism that Amphi has been coming up with?
Kaizad, I'm on print saying that I can lose my job on non-performance. I cannot lose my job on non-compliance. I'm a risk manager of this company. That's my job profile. Structurally, let me give you a brief. Recently, SEBI put in place that, you should have a trustee officer reporting to the trustee. We've taken it one step ahead and putting a vigilance officer reporting into the board. Both of them don't report to me. They're independent people who cut across departments, do whatever they want, and the entire office is available to them. Yeah, from a risk officer perspective, we identified a very young risk officer to take over the man. We believe he's excellent. And sometimes if you can see the risk meetings that happen and how he presents in front of very senior CIOs, sometimes I tell him, boss.
Which is what I always wondered.
Yeah.
Can your risk officers
So,
look into
so I was answering the salary part. Give him some time and you see the salary of the risk officer in my fund house, at least. But make no mistake, this is a business of risk. This is not a business of return generation. And people who graduate to holding the risk part of the business intact will prevail in the long run. It's been 16 years in India, not a single letter in any form from the regulator. It's something we take pride on. The last 3 years, we felt a lot of risks in the market. We've not agreed with the risks. A lot of people call us underperformers. We are completely comfortable with that. But if we are raising a risk call in the market, we will stand by that risk call, irrespective of who thinks with that, because that is the fiduciary responsibility. Time will tell whether we are right or wrong, but we'll hold on to the fiduciary responsibility as a job profile.
Can the industry do better?
I can speak for myself. But I can tell you this much, that upholding of the fiduciary responsibility as a criteria for selling a fund house is at a minimal. That's my honest submission in this forum. I don't think that's a tick mark in selecting a fund house.
Okay, so that brings us to the end of this interesting panel discussion. But before I let the four of you all go, I want to conduct a quick rapid fire, fun rapid fire, just for fun's sakes. So rapid fire, Radhika, Kalpin, Swaroop and Ajit. One question, very quick answer. Radhika, let's begin with you.
Do we get a gift? If you're going to play Karan Johar, we might as well get a hamper, right?
Let me first hear your answer. Okay, so you are a shark. You are in the Shark Tank. There are 5 new AMCs which were launched recently. Bajaj Finserv, Helios, Old Bridge, Zerodha, and Samco. If you have to give your money to one fund house as a capital, not as a unit holder, which
as
one
as an investor. Just name the MCs again.
Old Bridge, Helios, Zerodha, Bajaj Finserv, and Samco. These are the 5 last AMCs which were being launched.
Bajaj Finserv, and you didn't ask me why. So Bajaj Finserv and that.
I can't ask you why? Okay. Okay, at least for your honest answer, thank you.
I give you an answer.
I can give a reason for that.
Okay.
You can read my mind, Swaroop.
Please, please.
No, I'm a big fan of Nimish as a CIO, so my money is with Bajaj Finserv, and Samir and I go back a long way, and he on stage claimed that we were the best fund house, so my money is also with Helios.
Swaroop, your turn next. We know that you like music. You're often seen in music shops collecting LPs, record players, and records. If celebrity advertisements are allowed for mutual funds, who is that one singer or one music band or one group who would represent Media Mutual Fund?
Unfortunately, he's passed away. These 2 gentlemen, Kishore Kumar and R.D. Burman.
Ajit, tell me this very honestly. Would you rather be a fund manager or would you be a CEO come promoter of a fund house? Very honestly.
Fund manager.
Kalpin, last question to you before we hand over to the next panel. Your former business partner, BlackRock, is coming back to India. If you meet Larry Fink or any of the BlackRock mutual fund officials, what's the first thing that you would like to say to them?
Welcome back.
Okay, so thank you very much for all
Off
your...
the record, I tell this, it's not just BlackRock, but I see many global firms wanting to come back, including when I was in IDFC, we had Netixis. And they parted ways in 2014 because they said India is growing nowhere. So I keep telling them that at 15p, you exited India and went to China. At 25 PE, you're coming back to India and exiting China at 10 PE.
So stop blaming retail investors for return chasing,
Exactly.
na?
No, but guys, leaving India is very easy. It's not the same on the comeback.
Okay. So on that note,
You always want the last word.
So on that note, thank you so much, Kalpen, Radhika, Swaroop, Ajit. It's been fun talking to you. And thank you so much for being a patient audience. And we move on to the next panel now. Thank you so much.
All right, thank you so much. And we'll make sure Radhika chases Kaizad down for that hamper. And also for Kaizad to sort of figure out who actually won it. But on that note, let's move on now and focus on the other critical aspect of India's investment sort of landscape. Guiding new investors. Now, one of the key deterrents of new investors is the lack of financial literacy. For a new investor, advice is abundant, but trusted sources aren't so much. Now, according to SEBI, India needs 1 million investing advisors. The current number under same SEBI investing advisors is just about 961. So, guiding first-time new investors at scale is a challenge we collectively need to conquer for India's investment landscape to truly flourish. Our next panel now focuses on the future of mutual fund advisory and distribution mission SIP at 50,000 crore. Will the right advisor please stand up? With that, let me bring on our panelists. Please welcome on stage Kailash Kulkarni, Chief Executive Officer, HSBC India Asset Management. Can we also have Suresh Sadagopan, SEBI Registered Investment Advisor and MD Principal Officer Ladder 7 Wealth Planners Private Limited. Also, can we please have on stage Ms. Ba Max Musa, CEO NJ Wealth, and also Lakshmi Iyer, CEO Investment and Strategy Kotak Alternate Asset Managers Limited. All right, we're still waiting for one of our panelists, Lakshmi Iyer, to join in, but we'll start before that. Can I also bring in Abhinav Kaul of Moneycontrol to take this discussion forward?
Hello. Hi, good evening and welcome to the advisors panel. The theme of this year's Moneycontrol Mutual Fund Summit is how SIPs are empowering Bharat. Well, in the past editions, we have talked about how mutual funds want more and more investors to do SIPs. We have also talked about how we wanted to, as a mutual fund industry, we wanted to get more investors into the mutual fund fold. But today we are sitting here in 2024 and the SIP book has reached 23,000 crore. We have 5 crore unique mutual fund investors. Also, there are 20 crore mutual fund accounts. So mutual fund industry is going through an interesting phase where a lot of money is coming in. And predominantly this money is coming from first-time investors who are young, who are ready to take risk. And they haven't seen a bear market yet. So in this context, the importance of hand-holding and advisory gain prominence. So my first question is to Kailash. I mean, as an industry, if we talk about AMC's distribution advisory, what are the key challenges? I mean, you can look at it, the flows that are coming in, you can look them as opportunity or a challenge. Is the mutual fund industry ready or well-equipped to handle the funds that are coming in?
Is the mutual fund industry ready to handle the funds that are coming in?
Yeah.
I don't know why that question is being asked. We are very, very ready to handle the funds that are coming in. I think the key question out here is that are we ready to handhold the clients that are coming in the manner that they should be handheld? I think that's very important today because if you look at the last 5 years and just alluding to what you said, the new investors have not seen a sustained bear market or a 2008 to 2010 kind of situation or 2000 to 2003 when the markets were absolutely flat and did nothing. I think it's very important to set expectations for such investors in the right manner. Today, the new investors who are coming in, and I think the previous panel talked about it a lot, are coming in with a track record which has been extremely good in terms of returns. The truth be told that the returns in equity over a long period of time are anywhere which is 50% more than your risk-free rate, okay, which is in today's day and age early to mid-teens. So if you are setting the context and educating investors that that's what you should expect, anything above that is a bonus, I think that's what we need to really focus on, because just hypothetically assume that you end up delivering 18-20% returns this year. I know that many people will be disappointed because they're coming in with a much higher thought process of returns. I don't see money to be a challenge, managing money to be a challenge for two reasons. As India grows, I think there are far many more opportunities where people can invest. So the number of IPOs is growing, the depth of the market is growing. So I don't see that to be a big challenge at all. I think the bigger challenge is managing expectations.
Right. So coming to advisory part, Suresh, the number of RIAs, I mean, if you look at the number, your number is even less than some of the critically endangered species in India. It's less than 1,000. Now, recently, SEBI came out with draft paper suggestions. How do you think they will help? Will they help? How will they help? And do you think more MFDs, I mean, which is one of the key backbone of mutual fund industry, will more MFDs be interested in getting RIA license?
It's a great question. So I'm going to slightly step back and talk about the journey from where we are today in terms of SIP book, or rather the mutual fund industry's growth to, say, 100 lakh crores itself. See, we have done quite well till this point on say, a product-based selling. So that is precisely what has been largely happening. But if you want a growth from here onwards, it has to be a client-centric, advisory-based approach. I mean, the clients definitely have to, it's not a question of how much return they make. I think the last panel, they were talking about the returns and how it is not that very relevant in the overall journey. See, the returns are not really that very relevant. What is truly really relevant is whether the clients are able to run their life the way they want, meet the goals that they want, and if we really want mutual fund industry to reach that level. And I'm saying mutual fund industry because it is one of the most important ingredients in any advisor's portfolio. I mean, all the components. So if we need that, we need to take an advisory approach, we need to take a fiduciary approach, we need to look at what is important from the client point of view. Now coming to the question. So you were asking whether, I mean, the steps that SEBI has taken now, will it be helpful? I think I'm connecting what I just said with what steps SEBI has taken. I would really welcome the step that SEBI has taken because, I mean, in about 10, 11 years, we have come all the way up to 961. Okay. So now the industry was very, very difficult to operate in. The entry barriers were too high. And the consultation paper, at least, is making an honest attempt to bring down the level of requirements at the entry level. It is keeping all the other requirements intact. So a lot of people in this room, I'm hoping that, will probably transition as an advisor. Once upon a time, transitioning to an advisory capacity was very difficult because as an individual, you can do either distribution or you can do advisory. Now they have removed the threshold of that 50 lakh amount which you have to bring into a corporate, and they have completely made it zero. So many of the mutual fund people, I know that there are a lot of very good people with very good intention who want to make the transition. I think that transition will now happen, and that will propel the growth of the mutual fund industry also, and that is going to be very, very helpful from the point of view of the investing community.
What is the ideal number of RIAs, do you think? I mean, when we talk about 65 trillion assets, what is the ideal number of RIAs you think should have?
Yeah, I mean, the SEBI chairperson had mentioned about a 1 million figure. 1 million figure seems to be aspirational, even assuming that the consultation paper comes in its current form. Because see, let us be honest about this. Advisory profession is comparatively a much more difficult profession. So it's going to happen. People are going to test it out, and people are going to embrace it, and that's going to happen over time. It's not going to happen tomorrow. So I would say probably we should look at maybe over a period of time, 1 lakh advisors. I think that itself is an aspirational figure as far as the advisory community is concerned. But I think I would just say that at this point in time, they are taking the right steps. They have definitely sat up and taken notice that this thing is not working. Very happy to note that SEBI is taking those right steps. What will happen to the industry, we have to wait and watch.
Right. Now, Ms. Webb, coming to the distribution side, there are around 1.5 lakh MFDs, individual MFDs in the country as of now. The dream is 1 million. But and what more needs to be done, to achieve that number? And the RIA regulations or the consultation paper has come in. Do you think that will help to get more advisors into the fold?
See, if you see and understand how things have evolved over a period of time, today we have reached to a place where there are around 4.5 crore, 5 crore mutual fund investors in this country. In a country where there are nearly 140 Aadhaar, there are more than 75 crores of PAN. And the digital world has made mutual fund available at every nook and corner of this country. The mutual funds have delivered phenomenal returns in the last 25 years. Despite of this phenomenal returns which they have delivered over the last 25 years, the number of mutual fund investors are far lesser than probably the Demat account, or probably people playing around on a Dream 11 app. So somewhere we have to think that if you want to bring in financial inclusion, if you want to give the benefit of power of equity, power of real rate of return to the large part of India, which is a very diverse in terms of its spread, whether it is geographical, whether it is age, whether it is the income group, I don't think so in the world, India would be standing very differently. So if you want to retail it out to this mutual fund product and ensure that it reaches out to a large majority of the investors, and ensure that to get an investment in mutual fund is one story, but wealth creation is not a one-day story, it is a 20-25 years of story. So we also need to ensure that distribution channel, whether it is an advisory channel or whether it is an MFD channel, there is enough motivation for that person to handhold him for a longer period of time. Then only we can expect an investor to make money. बाकी आज के ज़माने में this recency biasness would make investor behave in the most unusual manner at different point of time. Today they have a good appetite of small cap. At some point of time they will run away from equity. So when you have to reach out to this large, diverse population, I think so we have to work together as to one model would not work. Okay, only advisory would probably not work. Even in mutual fund distribution, there has to be different type of people which will come in, because today there are wealth people. I don't think so they are going to come and go to a person who is going to invest 500 and 1,000 rupees of an SIP. So if you want to go and reach out to people who are to invest into 500 and 1,000 rupees on a SIP, there has to be a different kind of a distribution channel. Probably one has to really think and work about, right? So the whole point today is that how we are able to increase the touch points, irrespective of whether they are tagged as investment advisors or they are tagged as MFDs, so as they are honest in their profession and they're honest to their investors.
Right. I also want to talk about the quality of advice. I mean, talking about NJ Wealth, you have 41,000 mutual fund distribution partners. Now, out of this, 22,000 are based in B30 cities. And you have a client base of around 33 lakh, and 22 lakh are, again, in B30 cities. So how do you ensure the common minimum standards of distribution is maintained?
See, this can be done through two ways, and that's what we are doing. One is education and training, which is very, very essential, that how we are training our distributors in terms of their delivery is concerned. And second is creating tools which ensure standardized delivery. So combination of these two, that is training them in the right direction, in the right way as to how and what they should be preaching to the customer, and creating tools which they use. And if they are using those tools, automatically it ensures that there is a standardization to a very large extent when it comes to delivery of the so-called, that you are delivering becomes more standardized.
Right, right. Talking about...
Can I just add something to that? I think one of the first things we all need to do collectively as an industry body, as press, as everyone, is communicate that this is a fantastic and noble profession. Distributors are, I think you can equate them with some of the noblest professions in the country. So we don't look at it like that, unfortunately. And they play a very large part in terms of hand-holding clients' emotions, etc. Right? So I think that's something, if you sit, there'll be hundreds of stories which NJ Wealth will have on certain partners of theirs and how they are grown and how they are helping them grow by doing training, etc. I think it's important for us today, as an industry body, to 1 million is not the right thing. If insurance has 2.2 million already, and they find the 2.2 million inadequate, why can't we have that big jump in terms of the number of people touching base? The only difference I have, I'm not talking of whether they are RIA or MFD. I think the most important thing is, do we have a person to handhold them? Sometimes a platform, which is a pure tech platform where there's no hand-holding, may struggle during bad times because you can't cry on a laptop. You need a shoulder to cry on. Okay, I think that is very, very important. So whether you are an RIA or MFD, I think you have a role to play in terms of managing that client. And clearly, we are far short of the number of people we require, because I still think that we have not created MFD to be up there in terms of image in the mass market.
Right. Now, we are talking about hand-holding and quality advice. Suresh, in the IA draft paper, there is a suggestion on part-time investment advisors. Maybe SEBI has done it to offer opportunities to doctors, lawyers who want to come into the advisory fold. Do you think the bar has been set too low?
First and foremost, we require investment advisors. Part-time investment advisors can wait. I think if you look at what SEBI has done in this consultation paper, and if this consultation paper in its current form were to see the light, I think a whole lot of people who are waiting from the MFD community and other communities will troop in as investment advisors. It is my own personal opinion that part-time advice is ill-advised. So, because, let us understand this. Advisory is a profession. So just like a medical profession or a legal profession or architect as a profession, so it is a profession, right? So there can be no part-time people from some other profession coming into this profession and doing a good job. I don't think it is really possible. what we should actually endeavor to do is there are, I believe, almost 1.5 lakh MFDs. Many of them will be interested in transitioning, and at least for some of their clients, they may want to do a pure advisory. I think that is what we should aspire to in terms of increasing the numbers, and I'm sure that that is definitely going to happen. So part-time advisory, I don't think is going to fly. This is my personal opinion. I can again be proved wrong. But the first thing that they have done as far as bringing down the typical eligibility requirement is a great idea. And I hope and pray that it flies.
Got your point. Now, when we talk about 23,000 crore SIPs or 20,000 crore average money that is coming into equity mutual funds, the major chunk is coming into thematic funds, small cap funds, or the funds that have done very well in the recent past. Kailash, is there any way to remove or to at least mitigate this recency bias of investors?
It'll be a very long haul. Okay, and I think the previous panel said that. If the entire ecosystem is talking of 1-year returns, how is it going to change overnight? Okay, so everybody has a role to play. You have a role to play as a media house. We have a role to play as manufacturers. They have a role to play as distribution partners. I think all of us have to do it. Will it change in the past? The answer is no. It will be a long haul. So we need to be prepared for it. But I think if we can go by, and this is something which I said many, many years ago, and I'll repeat it. I'll take this chance to repeat it. Maybe somebody in the regulators may listen to it. If we stop ranking AMCs on assets under management and start ranking AMCs in terms of new customer added per year and publish that ranking, you see there'll be a behavior change. Your 4.5 crore customers will become 20 crores in the next 2 years. Because all of us love awards, all of us love ranks, all of us like to be number one. Okay. The beauty about ranking in terms of totally new customers that they have added in the industry, and you can do this every year, the chances that the 43rd AMC also can become number one for 2025. Yeah. And the number 3rd AMC can also become number 37th if they hadn't added investors. And I think SEBI wants new investors to come to this industry. And it's optical that if we stop ranking on AEM and start ranking on such things that we need to promote, I think the behavior change happens much faster than what it is intended for.
Right. Misbah, any views on how this recency bias can be addressed?
See, we as an organization, have been very focused educating the partners about this recency biasness. In fact, we have been in the last 1.5 years, we have been, saying the same story, and educating, as I said, is one of the very important aspects. And we are doing our part. All can definitely join doing their part. That there is no point to see a point-to-point return, especially the 1-year return, because the recency biasness itself says that when you see 1-year return, when you see 2-year, 3-year good returns, investor starts building that expectation that the same thing is going to come and repeat over a longer period of time. The best way, one of the best way, of course, to ensure that people don't get into the trap of recency biasness, one of the way, that's not the only way, is to start seeing the rolling returns, as Radhika ma'am also has said in her part. And that's what at an organizational level we have done, is that whenever we are publishing the return of the fund houses, we don't focus on point-to-point, which is only a one-day investor experience of that particular day, and it talks about it. We give a lot of emphasis on rolling returns, and especially rolling returns of 5-year, 10 years, though number of funds with that 10-year rolling returns are relatively small. So we give a lot of emphasis on rolling returns. The another benefit which comes out of seeing the rolling returns is that the expectation of the investor, which gets built up by seeing the recent returns, whether it is on a very high positive side or on a very low side, either way the market is behaving, when we start seeing the rolling return, you will see, if I take an example, if you say a rolling return of a Nifty 500 of more than 19 years and a 10-year rolling return I am taking in, I will get an answer of a median return of around 12.8%, right? So when you start showing rolling returns to the investor, whether it is a fund or an index, there are two advantages which will come in: the recency biasness, or the attraction of the low return, or a distraction from a very low return because the markets are cold would go out, and a fair expectation as to what I should expect from my investments, or return that you should expect from my investment starts building in when you start seeing the rolling return. And that's what we have been doing it. Sir also said we have been educating people on this 2018 story of small cap, where a lot of money came in and it just crashed. So as Kailash rightly said, we are doing our part. But till the time that whole ecosystem start working in a very similar direction, the concept or that recency biasness can go out. Because in most of the article, when we read through as to how to avoid recency biasness, the one answer which will, all the articles you read across, it will tell that go to a professional advisor. So, right? So for an investor to avoid a recency biasness, the answer is a distribution fraternity or an investment advisory fraternity. And somewhere that fraternity has to, behave very, very maturely when they are showing returns to their investors.
Right. Now, talking about the NFOs, I mean, the way new fund offers have come into the market, I mean, over the past few years, at least 100 of them come, and this year alone, till now, 110 or something has come into the market. Suresh, I mean, how do you view this, the new funds coming into the market? And when you advise a fund to an investor, what is the percentage between an old fund or a new fund? I mean, how do you juggle between these two?
As a general rule, we avoid NFOs. And there is a reason for that. The reason is almost all categories, there are existing funds by very good fund managers who are actually managing those funds very, very credibly. We always keep talking about that, about the fact that the past, future is not going to be a reflection of the past. I mean, while I completely understand that, we already know what is the way that particular fund house, what is the track record of that person, how they have been managing. We know that. We have some track record, while it may not exactly repeat. So, if that is the case, why would I want to recommend a fund which is a completely new NFO and it does not have a track record for whatever it is worth? There is no track record. So that is one. Secondly, as advisors, we are focused on the clients. We are not focused on returns. We are focused on ensuring that their goals are met over a long period of time. So we are really talking about, decades. So when that is the case, we actually believe in simple products. So whether it is a whole market product or a large cap product or an international product. So we make do with maybe 3-4 categories only. We are not into thematic, we are not into sectoral, we are not into most of those things. We believe that if the fund manager finds merit in certain sectors or certain themes, it will very well be a part of a diversified theme. So I don't have to play that role. The role that as an advisor I'm playing is that of a financial architect for my client. Mutual fund is playing a much wider role. It is giving us a lot of products which I can take and construct that edifice for my client. So the role is actually quite different. So, I am looking at NFO not as something directly relevant to me, maybe today, but if that NFO actually plays out and it becomes a credible fund at a later point in time, I have no hesitation in including that in my asset list.
Kailash, your views, as in how?
Slightly differing from Suresh, okay? I think when we say NFOs, we are putting all eggs in one basket. I think that's the first mistake we do, okay? There are two kinds of NFOs. One is a Me Too product NFO, which is mimicking one of your existing products. There I'll agree with Suresh completely. But there are a lot of new types of things happening in the country, environment, etc., where I think there are enough opportunities where the current products may not necessarily fit. Getting a product in that category is not a bad idea to do, okay? Let's also look at the positive of NFOs, because I think in the previous panel also there were questions, NFOs are kind of being bashed. NFOs get new clients to our industry. Whether we like it or we don't like it, the 10 rupee works, okay? New clients come into the industry, they hopefully see a good track record over 3 years and they diversify into other products. So that's a big positive for NFOs. So let's not diss NFOs out of the way. Let me give you an example, and this is a real life example I'm giving. Government of India has announced that they would like the exports to go up to $2 trillion, which is a healthy CAGR of 15% between 2024 and 2030. So exports is a big thing which the government is focusing on. So if I come out with a product which is an export-led product, is it bad for the investor? I am going to ride on a theme which the government is clearly identifying is going to be the next few years' future, right? Then coming out with that product, I don't think it's a Me Too product. It's a completely new product. So I think we need to differentiate NFOs between a copycat, Me Too, just for getting asset gathering as the word was used, or is it something relevant? Is it fresh? Is it new? And possibly something for the future. I think if we can differentiate these two, I think the answer is there.
Right. Building upon that, I want to talk about the product manufacturing side and not necessarily only about HSBC. There are 100 of NFOs coming out. Already there are like 1,000 or 1,600 funds available in the market. From mutual fund perspective, are you getting enough talent, manpower to manage these funds? And what according to you is the ideal number that a single fund manager should be managing?
So I can talk about our fund house, how many. We don't like to have a fund manager manage more than 4 funds. 3 to 4 is ideal. If he manages 8 or 9, then there's a serious challenge because typically they will tend to focus on the products where money is coming in. That's how it works. So we believe 3 to 4, if you're adding more funds, then you need to add more fund managers, and we keep investing in the team. Is it easy to get the talent? The answer is no. Okay, very blunt answer. It is, but we need to keep searching. So it is important to groom people, get them in as analysts, they grow, they become kind of joint fund managers, and then fund managers. It's a journey of 7-10 years. We've had a great track record in that. But I think we need to continue to invest in that particular sphere where we need to keep investing in getting talent and then managing that talent and ensuring we give them all inputs to help them grow.
Right. Unfortunately, we are running out of time. Last question to Suresh and Misbah. Do you think mutual funds are reckless, or do you think mutual funds are reckless the way they are launching new NFOs?
I certainly would not say that. Each of the mutual fund houses, they have a reason why they are launching a particular fund. A lot of them have, a gap in the product portfolio that they have. That does not mean that the investor has to choose all the funds that are coming into the market. So it's a conscious choice from the point of view of the investor. I have nothing against the fund house. So if a distributor or an RIA is recklessly suggesting NFOs, all that is coming into the market, it is wrong on their part to have done that for the client. There is nothing on the part of the fund house who is doing that. Yeah, there are other aspects which have been discussed in the previous panel. I will not get into that. But I have nothing to complain about the spate of NFOs. It increases the options. What we need to select, we are the advisors, we need to choose wisely for our clients.
Right. Ms. Ba?
Very, very similar answer. So till the time the fund houses have a logic and have ensured that they have things in place to ensure the funds are managed properly, I think the most of the fund houses do take care. And it is the ultimate responsibility of the distributor to understand the customer and give accordingly to their needs and the expectation, create a portfolio for them. It's a very large responsibility. I take it on the distribution fraternity to understand the customer and give to them as per their requirement.
Right, thank you. This brings us to the end of this panel. Thank you, Kailash, Suresh, and Misbah for the wonderful discussion. Well, a round of applause for our panelists. Thank you.
All right, a big thank you to our panelists for their valuable insights and the future of mutual funds advisory and distribution. Much food for thought over there. All right, it's time now to shift gears a little bit and welcome a very special guest. Someone whose career has brought vicarious pride to Indians everywhere for nearly 40 years. Let's take a quick peek into who we're really talking about. Ladies and gentlemen, let's put your hands together for chess grandmaster and former 5-time world chess champion, Mr. Vishwanathan Anand. I'd also like to welcome back on stage Kaizad, who will be taking this conversation forward, a special chat and unpack how chess players who think many steps ahead and use strong strategy and tactics, balancing risks and reward over there, how do they manage their careers and money? Let's find out. Ladies and gentlemen, it's time for Checkmate.
Thank you, Sonal, and good evening and welcome back, all of you. We are very honored and privileged to have Vishwanathan Anand among us. Vishwanathan Anand, as you all know, is the face of chess in India, has been the first grandmaster in chess, first Indian grandmaster, in chess. And for a number of years, Vishwanathan Anand has been the sole representative of India on the global chess scene. Of course, today we have a lot of Indians in the top 100, both on the men's side and on the women's side. I was looking at the rankings, the chess rankings a couple of days ago, and I noticed that there are 10 to 11 male chess players and female chess players in the top 100, and two of the male chess players are in the top 10, right, and 4 are in the top 20. So I mean, that's the legacy that Vishwanathan Anand has inspired, and inspired so many young Indians to take up chess. And today it is a popular sport. So we thought we should, use this opportunity to invite Vishwanathan Anand on our stage today to basically, of course, we'll talk about chess, but we're very interested to know, Anand, basically, if you can take us back through your career. We want to know things like, your vision about chess, how you inspired young Indians to take up chess, and obviously we'll talk about money, how young Indians, young chess players today manage their money, how you have managed your money, whether, of course, you invest in mutual funds or not, whether you do your asset allocation or not, whether you do your goal planning or not. So, Anand, as I was saying earlier, you have inspired a lot of young Indians to take up chess. Today, all the chess players of the Indian chess players on the scene today, they are popularly referred to as children of Anand. So how does that make you feel?
Slightly old. Also, at the beginning, there were one or two people who said genius, but by the end, they just gave up and said legend. I'm obviously very happy with how it turned out. I mean, when I was 17 and I'd won the World Junior, I was the first Asian to win the World Junior, and it was the start of a very exciting journey for me. At that stage, I didn't know yet that within a few years I'd compete in all the top tournaments and break through. But already within a few years, you could feel this effect that the number of participants in school championships, youth events, everything was starting to go up and up and up. So clearly, knowing that it's an experience common to many sports, that once somebody from your country starts doing well, excites you to give it a try. Still, it is surprising that now we are at 85 grandmasters, and as you point out, quite a few youngsters in the top 10. I've been overtaken by 4 Indians in the top 10 within the last year and a bit. So, yeah, dramatic changes. India is now just easily, I think, the first or second strongest country in chess.
So just to deviate a little bit, I was reading your book, Mind Master. I have a Kindle version of it, but it's a terrific book, very breezy read. And one thing that really caught me in the book is that, you actually tried to become a tennis player, or you took up tennis when you were young. And you tried your hand at tennis, but you've written in your book that you gave it up soon because the whole task of waking up at 5 o'clock in the morning and then going to the tennis court and then running around the periphery was too much for you. So take us back to those days and what went on with you. Why did you give up tennis? You could have become the next Bjorn Borg.
So what happened was, it's just my mother would put me into a lot of sports, and besides that, my father was in the railway, so everything that was possible to play in the railway club. So I used to play badminton, table tennis, and...
this was in Chennai?
In Chennai. And then one year, my father got a job in the Philippines, so we moved for 1 year abroad, and in fact, there my chess picked up steam. But even there, my mother found a tennis coach, and so I'd go through the motions. But every youngster plays a lot of sports, but there's one which either you're very good at or somehow captures you. And for me, that was chess pretty quickly. I was simply not good enough in tennis. So I was decent in club thing, but I never really got into tournaments and things like that. And so when we got back from the Philippines, my mother thought it would be nice for me to get back into coaching. And she found this coach and I had to wake up at 5 in the morning to be there at 5:30. And it annoyed me a great deal that he wouldn't, his routine was, okay, now run around the court. It was like half an hour class, but he would only get you in at 5:50. And then there'd be like a few forehands, a few backhands, you'd serve a few, and then your class was over. And I thought, well, why do I need him for running around the court? I can do that myself.
So that's when you...
That's when I stopped seriously pursuing tennis, but I don't think I was very close to becoming Bjorn Borg.
So you're cool and calm demeanor.
Yes, and maybe the fashion business, I don't know.
But seriously, what's the deal with Chennai and sports? I mean, you find so many great, sports people coming from Chennai, Vishwanathan Anand, Ramanathan Krishnan, Ramesh Krishnan, Vijay Amritraj. What is it about the city and sports? I mean, is there an inherent sports culture that's imbibed within kids when they are coming up in Chennai? Is that the reason?
Actually, it just became traditional for most Chennai boys to dabble in tennis.
I think the effect started with Ramanathan Krishnan clearly, and then very quickly, certainly my generation, but even a couple of generations before, everybody went through the tennis routine, and so it must have been Mr. Krishnan who sort of set the ball rolling. Yes, and of course you mentioned all the legends, the Amritraj brothers, Ramesh Krishnan and so on. It's still kind of flying, but we haven't had anything of that level for a while now.
So let's come back to chess. Anand, what's your overall assessment of the chess scene over here in India? I mean, for a number of years, you were the sole face representing India on the chess scene. Today, of course, you have a number of players. But do you think more needs to be done to popularize chess? Or do you think the popularity or the professionalism which is there, the level of play which is there, the standard, is that adequate enough?
A lot of the blocks have come in. So typically, if we compare with the Soviet Union, for instance, which is the legendary country that sort of everyone tried to copy, they had a system of, they used to have sports clubs in every small village. I think once a village was a certain size, it had to, by law, have a sports complex. And whether your child wanted to do gymnastics or athletics or chess or what, a coach must be assigned to you, which means they had that, even a small town had to have a coach or someone visiting. And so this highly structured way of funneling interest and talent. For a lot of people, it was simply a healthy lifestyle, but for a few, the ones who were good at sport, they had good facility, at least one good facility in every town. And you could build on that, and regular exposure to the best talent. It was a very, very good system. Our copy of that, I think most of the blocks are there. Of course, the incentive is slightly different. It wasn't that a law was passed, but simply people started coaching academies and so on. But so after I became a grandmaster, there were the next 7 or 8 grandmasters. Almost all of them have academies of their own. All of them have trained youngsters. And in many cases, some of these grandmasters have then gone on to have their own academies. And the current generation came out of that. So we can see that the ecosystem, if you like, is filling up. There's still gaps.
More government support?
Finance is one.
More government support?
The government, I think, has been a good baseline. They have supported us from the beginning. Even in the 80s, when I was going, I benefited from government support. I used to get tickets to represent India in all foreign competitions. Sometimes they would throw in some tournaments to get experience. And that has been consistent. And clearly the government is spreading its sports budget on a lot of sports. I think the government should focus on exactly what the Soviet Union did, which is as many good facilities no matter how small the town gets. I mean, you can't go too small, but at least every reasonably sized town or village should have one good sports facility where, an athletics track, a couple of chess rooms, things like that. But happily, the number of private sponsors is going up. Now most of the chess players, yes.
Do you get corporate sponsorships?
Yes, we have, most of our players, the top 10 or 12 have sponsors of their own. Besides that, there are lots of people who support young talents who are at a much earlier stage. Even there are WhatsApp groups of people raising money for this. So, all the creative solutions are there. And it is getting better. I wouldn't say that it's complete, and there are clearly a lot of people, youngsters who need help. But, slowly the system is coming. And the other thing is, of course, the amazing Indian parent. You have parents who go through tremendous trouble for their kids. And that is the backbone of the Indian sports system in general. So in chess especially, the parents go to a lot of trouble. Some of them even quit their own careers and spend the time supporting their youngsters and so on. But ideally, you'd like them to have a helping hand and not do something desperate. So it's good that the average support is getting. It's uneven. The South clearly is the region which dominates in chess. To some degree, the West as well, but the South mainly. And these things are much easier to get down there than anything. But now, slowly, it's spreading out.
Okay. So what is it about chess that attracts such young talent? I mean, I believe you started playing chess when you were 7, 8, and you have teenagers, kids, 11-year-old, 15-year-olds attaining grandmaster status, being in the top 10 before even they turn 21. So one is that what is it about, what is so unique about the game that attracts such young talent? I mean, you find players in other sports, they peak when they are 25, 28. Here people peak when they are 12, 11, 13, 14, 15 years of old. And I believe that also leads to my next question as to how do they handle all the fame, all the money that comes their way. I mean, if you can give me some of your experience of what you say, see players like Gukesh going, I mean, how are they coping up with all the fame and money that comes their way?
Okay. My explanation for that is chess is, of course, a sport, but at one level, it's like a language, which means that you learn to speak it intuitively. Even if you don't grasp, the grammatical structure and the reason for this and that, you speak it intuitively simply by hearing your parents. It's very, very similar with chess. Somebody who starts playing chess eventually makes a lot of connections. If you ask them, why is this the best move? A 7-year-old probably won't be able to tell you. But he or she will find it again, and then they'll find it again. So that's one reason that youngsters do well in chess, and this has always been the case. It goes back almost 100 years that youngsters are very good. And it's cultural as well. Typically, it's a sport that your father or your grandparents will show you. In my case, my mother, when I was 6 years old, will show you and teach you how to play. And people think it's good. It's a good, healthy mental activity, as opposed to any number of inferior substitutes. And, it's a good thing for the child to learn. So these two factors help make it very young. The sport has developed a lot recently. I mean, it's been growing steadily, but we benefited hugely from the pandemic boom. So during the pandemic, we discovered that there were tens of millions of people who apparently always wanted to play chess, but never found the time. And then they were stuck at home with their phones and excellent bandwidth, and they started playing chess. And that also explains why a lot of the youngsters now are so good, because they got in their 10,000 hours of practice during these 2 years, from 2020 till 22, when they were stuck at home. They played an incredible amount of chess, and a lot of chess players, being unable to travel, sat at home recording training videos and putting it out there. So the coaching infrastructure became incredibly good. And I think it's going to get younger and younger and younger now. But just that one last point. So now this has obviously meant good prize funds, increased sponsorship, and so on. I think most youngsters are fairly sensible about it. Like, I think Gukesh is still very young, not even, he's just turned 18. So I think he lets his father manage his money for him for the moment. But they're all very practical, and, having not had so much just recently, I think they still have the memory of that, so they're quite sensible about it. But it's true, many of these youngsters, and I credit the parents mostly, that it hasn't gone to their head. It's still very, very level-headed.
So, when you were winning, when you were coming up in chess and when you were winning all those titles, how did you manage your fame? How did you manage your money at that time? How much freedom did your parents give you? How much curtailment was there?
Okay, so I started to come in local newspapers in Chennai, when I was winning school events and so on. But then there were some clear milestones when I became a grandmaster, because that was like an Olympic gold medal or something. I remember being featured in almost every magazine at a national level, and then for the first time I had to deal with that kind of fame. Then later that year I became a grandmaster, And so the process repeated itself. But there was a gap. I think most people had heard of my name, but had not seen a photo of me. And there's a nice story, which maybe you stumbled on in the book, which is that I was traveling in a train once, and one elderly gentleman and me started chatting. So he said, he asked me, young man, what do you do? And so I said, I play. I just turned a grandmaster, so before I would have deflected the question by saying I'm going to be an engineer, because you knew how it was. If you said chess player, kind of threw people off. But I thought, as a grandmaster, I can maybe probe and see how people react. So I said, I'm going to be a chess player. He said, but what do you do? And I said, no, I'm going to play chess for a living and so on. And then he said, young man, don't take this badly, but sports is a very risky career in India. Unless you're Vishwanathan Anand, it's very difficult to make a living. So, and so that was nice. I was famous and not very famous at the same time, the same conversation. But I guess I settled into it, and with money as well. There was a clear difference once I started getting invitations to the very elite events. This started happening in 1990, so I was 20, 21 years old. And then, the money was, it made a big difference to me. For the first time, I was not dependent on someone or, family to, and even then you were dependent on only the amount foreign exchange sanctioned. So you had to go get a sanction for, $20 a day or $40 a day, and then you had to stay within that. And so for the first time when I was, I think it gave me some freedom. Of course, I made some rookie mistakes initially. I wouldn't really say the mistakes with my investment philosophy or something. I just say rookie mistakes with your first paycheck.
Which mistakes? So
a couple of times I had the feeling that it was quite easy to make money with currencies because, the way with the movements you could think. And a couple of times I tried punting on currencies. And very quickly I realized, okay, there's a reason there are some experts doing it. I should probably stay out. And after that, it was mostly sensible. One thing that chess players, and I think a lot of sports people encounter is that the uncertainty of earning. So you don't know how good your career is going to be. And I think my generation in chess was a transition. The previous generation, they were artists. And so their thing is, I'm going to play chess no matter what, it doesn't matter. But especially my generation was very, very practical minded. So we all started saving quite quickly. And then when I got married, my wife was even more sensible and things. So in the sense that I could get distracted very quickly. So very large portfolio, too many things, I'll get bored after a few things, but my wife is much more methodical.
Yeah, we hear she's the money manager of the household.
Very much. So in a sense, we realized that, because just like in chess, one or two good moves can't rescue a lot of bad decisions.
Do you listen to her advice?
Thing. She doesn't even, I trust her in a sense, and she does it. She doesn't run everything past me, but I think we broadly on the same philosophy. And within a few years, I had come around to asset allocation, and I felt that mostly my money should be, equities and the split. Obviously, a lot of mutual funds because that's very convenient, and just investing regularly for the last 25.
So how do you plan your investments, in the sense that do you do financial goal planning? Do you say that I want to save for this goal, I want to save for that goal, or is it just that you invest because something is giving you a good decent return? What's your approach when it comes to selecting something where you want to put your money?
I think for goals you can put things aside, but My philosophy is more focused on, just growing it. So obviously to deal with the complexity of the thing, we have an investment advisor. We work with them, and they're quite familiar with, what are my financial needs, when I need to spend, and so on. There was a time when, okay, there's a lot of money coming in, but also I had a lot of expenses, so you had to balance it out. And so we planned for liquidity and having cash available and things like that. But, I got a place to live. We knew what my expenses would be roughly, and that's it. It's not like I especially have money for medical expenses or especially for my son's education or something like that.
Do you like to take risks? Do you like to take risks?
Yes,
Or are you a very calculative investor, like how you're on the chessboard?
I think a bit of both. I accept that some amount of risk has to be baked in if you want to make any money. So I certainly think, well, okay, this sector is going to do well, that sector is going to do well. I look at advice and so on. But I will bounce it past. I'll mention it to my advisor. Certainly, I'll discuss it with Aruna, and I'll explain why I think it's an idea worth doing. And it's good because I might have some blind spots. Maybe they'll spot it and so on. And yes, so that's luckily, thanks to where India is, my style of investing has done, pretty well over the last 20 years. I think most people are doing quite well. And given our population and everything, I assume that will be true for quite some time more.
So Anand, I'm asking you this question because again, there are so many young chess players around, and chess is a game where, you will find a lot of 10-year-olds, 15-year-olds, 17-year-olds achieving grandmaster status. So do you feel that chess as well as financial education should be inculcated in the school curriculums so that, not only benefits the greater good, but in a way it might benefit your sport also, since you have people attaining such status at such young ages?
I agree 100%. I think chess should be taught in schools, and it is being taught in more and more schools because there's quite a lot of data showing that students who are exposed to chess, and by the way, this is not 20 hours of chess to become a grandmaster. This is 1 or 2 hours of chess a week just to train your thinking habits, your ability to recall prior situations, and mostly knowing that some decisions can't be reversed. So you've got to think before you make that move. So it's more of a healthy habit in the same way that physical sports are good to build up your stamina, your muscles and so on. Chess, I think, trains good mental habits. With financial education, I think, yes, every youngster should first of all manage their own accounts for a while, even if it's a mock account. But financial training is essential because it's so easy. I mean, we're not even talking of scams and pyramid schemes and so on. It's so easy
There's so much of noise
to misunderstand
also on social
risk.
media today.
Sorry?
So much of noise also on social media today. Today, it's, people are exposed to, kids are exposed to social media. You get a lot of advice from here and there.
Yes, and again, this habit of saying something is good without putting it in context. This is very, very true in finance. It's true in a lot of cases as well. I mean, you can talk about almost any scientific subject, but unless you place it in, this is where we came from, this is all what the data showed a while ago, this is what's happening now, it's irrelevant. You can have any data point. But in finance, you can actually lose money while you're doing this. So it's very important, I think, that certain basic financial skills should be taught right away. I mean, people should know that. Well, when I got my first email account, I mean, so many people purporting to be from Africa who are offering me $25 million accounts that just couldn't leave the country and could I lend them some money to think? Okay, that was baby-like, but we constantly get sophisticated versions of this, and you're just going to lose a lot of money if you don't have it. And it's good training, because I'm not talking only of financial management. We're talking about risk, how it functions in society. We're talking of probability. We're talking of a lot of concepts that should be part. Now, I don't mean that somebody will learn to dominate these subjects. Just a basic thing, so that at least they should see some red flags very early.
Can chess players become better investors? Because, they have a mathematical bent of mind. You're always calculating. You're always using your mind so much.
Amongst professional chess players, which is the group I know, people who tried to be, were professional chess players for quite some time, and then at some point decided they would switch. There's a fair amount, because there were a couple of companies. I remember Bankers Trust used to advertise for chess players.
I meant to say your own personal finances. When chess players manage their own personal finances,
I see.
Do they calculate? Are they calculative? Are you calculative?
Chess players I haven't discussed it that much with them, but I know that many of them take a lot of risks, but study the subject quite a lot. So very similar to the way they play chess, which is to see prior games and then go for it. But quite a lot of them take a lot of risk. But in general, I wanted to say that many chess players moved on to careers in finance and markets and did very well. And then we're not even talking of the group of chess players who played chess for fun at the beginning and then went to finance directly. But clearly, the way we study chess and the way you can study finance are very similar.
Okay, Anand, we are completely out of time, but I have to ask you one question before I let you go. Just from the point of view of popularizing chess or spreading chess's popularity throughout the nation, everywhere, OTT and television and films have played a decent kind of a role in popularizing other sports. We've seen movies around cricket, around tennis, etc. But around chess, there was a fantastic TV series called The Queen's Gambit. Have you watched The Queen's Gambit? Did you like it?
It is a very good series, especially for chess players, because for the first time the pieces were exactly where they were supposed to be.
Okay.
Most people when they watch a chess movie, they think, oh, that was amazing. But the chess player is thinking, no, that position's illegal. The king can't be there. Stop doing it, So we were happy with this one.
So would you wish more television, or would you wish more movies to take on chess as a subject?
There's a reasonable amount already. Unfortunately, always it's some villain. The moment I know that I see a chessboard in the background, I know he's going to do some terrible plot. But it's better than nothing.
Okay, thank you. Thank you so much, Anand, for joining, and a big hand for Vishwanathan Anand for joining us. Thank you.
All right, thank you, Mr. Vishwanathan Anand, for sharing your incredible journey with us and inspiring us with your wisdom. All right, with that, we return to our discussion on the financial landscape. Let's dive into the factors driving India's long-term equity market. Now, according to several experts, India is being considered the best long-term equity market globally. Driving this bull market is the confluence of factors. It's growing retail participation, robust domestic demand, demographics of an aspirational population, digitization that democratizes access, and the strong India growth story. Along with that, there is the enthusiastic fund flows. Within this rosy macro picture lies the micro trends that bear examination. With that little sneak peek, let's bring on our next panel, that will be examining whether mutual fund flows are a boon or a bane in the current market context. Let me bring on Mahalakshmi Narayanaswamy, Senior Consulting Editor, Moneycontrol, to moderate this discussion. And let's also welcome our panelists on board, starting with Rajiv Thakkar, CIO and Director, PPFAS Mutual Fund. We have Roshi Jain, Senior Fund Manager, HDFC Asset Management. We have Dinesh Balachandran, Head of Equity, SBI Mutual Fund, and Ashish Gupta, CIO, Axis Mutual Fund. Also, Sanjay Chawla is here, CIO, Baroda BNP Paribas Mutual Fund. The floor is yours.
Am I audible? Delighted to be doing this, of course. All through this evening, we've been talking very positive things about mutual funds. We have good reason to do that. This is a mutual fund event, and there is a lot of good things to talk about mutual funds. There is great amount of feel good, something that we've been waiting for a long time, at least me as a journalist of 25 years experience. Every time there has been a bull market, one always worried about what is coming next. And this SIP flows that all of us are talking about, this gush of domestic liquidity that is keeping markets rising and higher, comes after several years, not several years, actually 3 decades of mistrust in equities, from the Harshad Mehta scam to the Ketan Parekh scam to the global financial crisis to taper tantrum and all of that. And now, obviously, after 3-4 years of fantastic returns, one can't stop thinking about, what is to come. Is this too much of a good thing that we are seeing in the markets, and where does this lead us? That's one reason I'm super excited about this panel. Also, because some of the people on this panel they never do media appearances, you won't see them on TV. And I'm doubly grateful for you to take the time out, especially Roshi Jain. I think Roshi is coming for the first time in media, I don't know. Dinesh, all of these are reclusive people from the mutual fund industry. So even more excited to do this. So the first question I'd like to ask, maybe start with Ashish, because he put out a fantastic piece, I think about a month ago, talking about the demand-supply situation in the market, where he pointed out that since April 2022, we've seen supply of paper at about 4,80,000 crore, thereabouts. And the net flows through mutual fund industry was about 2,61,000 crore. So the supply of paper that came into the market, whether it be IPOs, QIPs, preferential offers, promoter sales, PE, all of that was about 4,86,000 crores. And the total amount of money that came through mutual funds, net flows, was about 2,61,000 crore. Despite that, we normally know that, if supply is greater, demand is less, then obviously prices have to go down. But during this period, the Nifty actually went up about 40%. This is in the context of a global market, that is S&P 500 during that time went up only about 22%. Now, explain to me the unsaid part in that, which is this run-up in the market, how much of it do you think is explained by the flows? How much of it is explained by growth? And how much of it do you think is just this general positivity around any bull market? And it's just word of mouth and people just latching on to something and therefore prices go up.
Sure. So thanks for inviting me, Mahalakshmi and Moneycontrol. I think, we talk about demand and supply in the market, but 99.9% of time in the market, demand is equal to supply, right? Because that is why a transaction is happening. When someone is buying, someone is selling, right? So only in the odd occasion when the market is at circuit that there is not a counterparty. So otherwise, theoretically, in the market, demand is equal to the supply. What changes is price, and the impact really comes because of differing expectations, right? I think mutual fund flows have been rising, but I think there have been previous times in the market where domestic inflows have been very strong. Retail interest in the market has been strong, either directly, not so much through mutual funds. But what really has changed in the last 3-4 years is that there has been a buildup of what we can really call systematic inflow into the market, right? And this is evidenced by SIPs. It is coming through the insurance companies. So like LIC invests about 1.2 lakh crores annually in the market. Private insurance companies are now a large magnitude as well. Then we have EPFO allocating. And today, if we aggregate all of these, that itself is somewhere about $35-40 billion inflow annually that will come in the market, right? And this is giving a strong confidence underpinning to the market that there is going to be some level of consistent demand. So it is not just feast and famine, but there will be $30-40 billion of consistent demand coming in. Of course, there are multiple players in the market, so just mutual fund and insurance companies are not the only players. There are foreign institutions that are involved, domestic retail is involved, private equity is involved, and the sum total of all of those, as I said, is that net demand-supply gap is zero. But what has really helped the market momentum is the confidence that a large amount of demand is now consistent demand, not really sentiment-driven demand. As you highlighted in the note I put out a few weeks ago, we have since April 23, since more than 4.5 lakh crores of supply by promoters, private equity, IPOs coming into the market. And that has really outpace what was the inflow from the mutual fund. So the mutual fund inflow over this 15-month period was roughly 3 lakh crores, the net inflow. But really still the market went up because in addition to the mutual fund inflows, over the 15-month period, FIIs also have been a net buyer. Direct retail has also been a strong net buyer of nearly 2.5-3 lakh crores. So that has meant that there has been a very strong impetus in the market. What I wanted to highlight is that, yes, while the narrative is strong that consistent inflow is high, there is a consistent supply also at this level. And the market direction going forward will be determined by the more volatile pieces of demand, which is FII demand, which goes through its cycles, as well as domestic retail. So domestic retail interest is very strong today, but it varies.
Sure. What's your take, Dinesh? I think the one part I'd probably like you to expand on is the fact that, according to Ashish's calculation, more than 5 lakh crore of supply can come into the market over the next 3 to 5 years. Isn't that true? So in which case, where do you see the market? Is that commensurate with the kind of demand that we, that could be created through domestic flows? Or are we going to be in a situation of oversupply?
In general, I've always felt that supply-demand is a second-order effect. It has an impact on valuations, it has an impact on markets, but the primary impact is always earnings, it's always growth, essentially, right? Supply-demand, it matters, but it's a second-order effect. So when you think about where markets are going to be, the question to really ask is what is going to happen from an economic GDP growth perspective? Because that is the number one driver. When you think about why markets have done well over the last 3-4 years, right? You also have to ask yourself where all these cyclical sectors were 3-4 years ago. A lot of them were essentially had just gone through a decade-long underperformance, where a lot of the weaker players exited that space. So the remaining guys were the survivors, and they slowly started having pricing power. So even with a very modest increase in order activity, you could essentially see the margins improve substantially for these players. And so it's no wonder that a lot of the cyclical companies have done extremely well over the last 3-4 years. The challenge right now is, yes, supply or demand rather has been extremely strong, be it from retail investors, either through direct stock trading or through investments in mutual funds and insurance policies and so on. So that's definitely played a role. But if I have to think about where markets are likely to be over the next 3-4 years, I keep wondering what is really going to happen from a GDP growth perspective. And if we believe that a lot of these cyclical sectors have only now gotten off the mat, so to speak, yes, margins have improved, but the order book is not in such a tremendous shape where you can say that, oh, they've had like several good years of, high double-digit order growth and stuff like that. We haven't seen that. And from that perspective, unless and until there is a serious accident, I would like to believe that that should continue. And if that is the case, even if you have a derating in terms of valuations, because valuation multiples are very high, no doubt about that, but the outcome is not going to be as bad. But this situation changes if you believe that there is going to be policy paralysis, the GDP growth rate, which a lot of people are believing that it can probably finally accelerate above the narrow band that it's been in. If that doesn't happen, then guess what? All the supply demand, it doesn't really matter. Markets are going to struggle, essentially.
Sure. What do you worry about, Roshi? I mean, last 3-4 years, like he said, I think a big part of the trade was that we were in the dumps in terms of, where we were in the economic cycle. And as the economic cycle, I think well before COVID, we were already in a slowdown in 2019 or so. And of course, the last decade was nothing to write home about. Right now, over the last 4 years, that trade has already played out. A lot of what Dinesh is perhaps talking about, operating leverage and all of that. Now, where are we? Can we sort of course, it'll be too obvious an answer to ask a question saying, can we replicate the performance? But does it get you worried?
Clearly, I mean, valuations is one part of the story, which is that, yes, there are pockets of overvaluation and significant overvaluation. But I do think that if we don't look at it from just a 1 year or a 2 year perspective, and if we take a slightly longer term perspective, corporate earnings are still perhaps going to grow, somewhere in the low to mid-teens. And there will be segments and sectors which will offer the compounding opportunity. So while valuations at this point from a 1-2 year perspective are stretched, I think over a 5 year plus time frame, there are still segments and sectors which will continue to give us that compounding growth opportunity. I think what I worry about genuinely is that this general euphoria has taken away some discipline in terms of the way we look at stocks and valuations. We've perhaps started to paint almost all companies in most sectors with the same brush. I think the kind of analytical rigor in terms of separating the good companies from the bad has perhaps been diluted a bit, and that's because we've had this very strong euphoria in the last 2, 3, 4 years, where perhaps weak performance hasn't been punished as much as it would have in the absence of this huge liquidity. So what I worry about is just this sort of dilution of discipline and rigor, which generally happens when you go through this very euphoric liquidity and good times in the markets. And not to say that we will not have companies which will give us compounding returns in the next 5, 7, 10 years. It's just that we need to be sure of the companies that we are backing at this point in time.
Sure. Good you picked on that point, because I just listed a number just before coming here, a comparison of PE distribution. I mean, I know everybody doesn't subscribe to PE as a metric. It's very rough cut. But nevertheless, in 2008, more than 68% of the companies had less than 20 times earnings. Right now, that number is less than 28. So in a sense, there is a sort of a reversal that majority of the market is really sitting on a higher plane. So Rajiv, how is the playing ground today compared to the peaks that you have seen in the past? Does it put us at greater risk of diminishing returns over the next few years?
I would think yes, Mahalakshmi. So various kinds of supply comes into the market, and typically if companies are issuing fresh equity for capital expansion, capital expenditure and capacity expansion, that's a good sign, right? Economy is growing. The worrying sign that I see in the past year or so is strategic investors or promoters are selling stakes in their companies because they don't find it worthwhile. So whether it be MNCs or whether it be Indian family promoters, they are selling stock because they don't find the stock attractive enough. And arguably, they are the people who know the business the best. So it is said in jest that at the beginning of the bull market, the promoter has the vision and the retail investors have the money. And towards the end, the promoters have the money and the retail investors have the vision for the business. I think that is the worrying part. A lot of offer for sales are happening. A lot of secondary market sales are happening. 20 P, let's say if P is stretched, maybe we are factoring in 1 or 2 years of extra earnings. That is fine. But in a lot of pockets, you have numbers like 70, 80, 100. You have loss-making companies. You have multiple narratives. So you have high valuations on quick commerce and you have a high valuation on big box retailers as well. Now, arguably, one will eat into the other. Everything cannot do well all the time. So you have EVs doing well and you have traditional autos also doing well. So somewhere something has to give. And the other worrying factor for me is maybe markets are discounting 2 years earnings ahead or something like that. That would be okay, more or less. The fact today is an entire generation of new investors have not seen a sideways market or a bear market. And they have just come looking at the rear view mirror, trailing returns. What happens when there's a 6 month of a tough period is untested.
Sure. From a product perspective, Sanjay, how do you see this market? Because traditionally, I think Kezad also quoted a lot of numbers in the first session that we are at record in terms of, NFO collections. For the first 8 months of this year, we've already surpassed total collections of last year. And we have, this is also driven by thematic funds. And we've known, every time there is a market peak, all these products come in and then they are backbenchers. So is that a contrarian sign? Being a product designer, what's your take?
So that's a very interesting...
Because you guys are the manufacturers of this whole thing.
So first of all, I think there's a lot of time spent on the NFOs and the thematic funds. The way I would look at it as a manufacturer, if there's a white space and the regulators define what are the spaces that each fund house can actually have. So if there are white spaces, they would launch it. For example, 2.5 years back, we did not have a flexi cap fund. And I think there are some fund houses who still have a white space in some of the key categories. And that's where the product launches are actually happening. They need to build up the track record, and once it's there, then they'll be able to sell it out there. Clearly, what we've seen is a trend where the manufacturers don't really have too much of space in terms of new products. And there are certain themes which are emerging. It's not that the manufacturers are just producing to gather assets, but clearly there are some new ideas, new themes emerging. For example, the new energy theme which is coming through. It's actually throwing up a significant opportunity. Would I take a significant portion of my portfolio in the new energy theme, despite the fact that I believe it is the right theme? I think those are the opportunities that the investors are trying to encash out there. And that's something which can throw up interesting investment opportunity for the investors. The question that we should be asking ourselves, are these themes enduring? Are they long-term? Or are they cyclical? Because we've seen that happening in 2008. Kalpen mentioned about the infra theme. It went through a cycle, a down cycle, and they had to relaunch the whole thing. So, for example, as a fund house, instead of launching an IT fund, which may be cyclical, we decided to launch an innovation fund. Okay? So it captures not only the IT sector, but the entire gamut. And I think innovation as a theme is going to sustain and be more durable than maybe a sector fund, etc.
Sure. Dinesh, let me pose this question to you. You are the largest, you represent the largest mutual fund in the country, and everyone is launching new funds. How much buy-in do you guys have as fund managers in what funds are launched, what themes are launched?
Oh, there is significant buy-in. Actually, when you think about the internal discussions that happen, now obviously, when you think about it, right, there can be a perceived conflict of interest where if you are wearing a sales marketing hat, you are always going to think about essentially getting that next rupee or next dollar in. And from that perspective, NFO always represents a good opportunity. As someone was mentioning in the previous panel, NFOs do bring in new people into the industry. So if you are just wearing a sales and marketing hat, you are going to sort of pitch that, right? From an investment professional perspective, you are worried about the ramifications of these NFOs in the sense that you are the one responsible for what happens post-launch. So if you are not convinced on the theme, it's going to be a big challenge. So when we have these internal discussions in terms of, okay, which NFO, if at all, we want to launch, there is an extensive discussion in terms of what we are okay with and what we are not okay with. Stuff that we are not okay with, we just put our foot down and say that...
Have there been instances like that where the product team wanted you to launch a few funds?
Multiple.
And you said no?
Unfortunately,
you're not ready to manage this?
Too many to count, to be honest. Because I don't even want to talk about specific themes because other funders have launched and it's their call, right?
We'll go to for that.
No, but there are themes that we, frankly speaking, don't believe in. So we've said no to that. And so then it's really a question of which themes do we believe has staying power. And that's basically, those are the themes that we've decided to sort of bring to the market. And they're also sort of represented in our other funds in terms of, if you really believe in a theme, it has to be seen in our funds, right? So from that perspective, there is clearly a harmony there that we believe in the other funds. That's what we are bringing to the market as well.
Sure. Ashish, you think we are setting investors for disappointment with thematic funds?
So I think Sanjay touched upon a very important part, that the theme has to be long-lasting, right? It does not, cannot be very cyclical, right? And he gave the example of infra. Frankly, if you see 2000 or even 2020, 21, IT funds got sold the maximum there, right? And the challenge is some of these things become flavor of the day and therefore get attracted. So I think the way we have thought, and like Dinesh, we have big tussle with our product and marketing team because they want to do what sells most easily in the market. But really, the other lens we see, besides the long-term structural theme, is that the theme should be broad-based enough for us to actively manage it, right? Because I think all houses or most of the houses have passive products as well. And if we are launching a theme, it has to be broad-based enough. It has to provide opportunities to invest in multiple set of companies, multiple types of businesses who do not have congruent business cycles. Because then really the fund manager can only deliver you beta. He cannot deliver you alpha. So if we have to deliver alpha, so for example, we last year did one thematic fund manufacturing, we are doing another one consumption actually from next week. The whole idea is that manufacturing is not just now about autos, right? It is, so in our manufacturing fund, there's auto, industrials, pharma, etc., right? And all these cycles don't simultaneously go up or down. Similarly, in consumption, there's FMCG, there's retailing, there's quick commerce. In fact, we even have stuff like real estate, etc. So there are multiple cycles within the broad theme you can play. There are diverse set of companies you can invest in to try to give an investor more consistent experience. Otherwise, I think if it's a narrow theme, we would rather just launch an index fund.
True, but looking at the NFOs that have been launched and the themes that have been launched by the industry, is that truly the case?
So each to their own.
I see that a number of people coming onto our channel are outright rejecting defense, pocket of stocks. But we've had like some of the highest collections of sectoral funds
I
in
will
defense.
actually say that my belief is we are manufacturer. So in the sense, if an investor wants to buy, then in these themes have an index fund, right? So because then the investor wants to buy the beta, his advisor wants to buy that theme for 2 years. He believes that he can take the call for 2 years or whatever time that theme will work and exit. So I would prefer to have a passive fund in that category. Because today the competition is not just among AMCs, it's between active and passive fund managers as well. And I think active funds have to give more consistent returns.
Does passive really solve the problem, Roshi? If you're bearish on the sector, you're bearish on the sector. I mean, it wouldn't have helped to have a passive fund in technology in 2000.
You're asking an active investor, and clearly, you know what the answer will be. But there's one thing that I think we need to realize, which is that this is a natural process of market evolution, and this is not just happening in India. As markets mature, as profile of investors increases, the number of investors, the reason why they are investing, you will have to come up with solutions for them. You can think about any industry for that matter. When the automobile industry started in India, how many car models did we have? You could count them on your fingertips. But as the market grows, as newer customers come into the industry, there will be a significant scale, even in a small niche. And then somebody will start addressing it. Today, how many car models? I mean, and we are still perhaps nowhere compared to, some of the more developed markets. My point is this, that as the Indian economy has grown, it has, and as the markets have evolved and matured, it has created significant scale in even niches, which is what I think mutual fund houses are trying to address. Now we've talked about, and there are different themes and so on, so forth. All I'm trying to say is as the mutual fund industry also grows, it is trying to address these niches. And that's what I think we are solving for. These need not be your generic products. These may be suited to a few investors, and that's why you have advisors and distributors who will see whether that product is suited for their investor and then accordingly position that product. So I think when we talk about thematic funds and all of that, this does not have to be a mass product. This could be for your niche investors who perhaps need or understand the risks and want to take that slightly higher bet, which you cannot do in a mass product. There may be many themes which are very underrepresented in a mass flexi-cap type product, and an investor perhaps wants that little bit more risk. You just do it via this niche that is offered. So that's my very broad take on thematic funds and so on. Yes, some of it will be cyclical, but so be it. I mean, if you're a sophisticated investor, you clearly understand cyclicality. So then you know what you're getting into. So I would just say that as markets evolve, we should be prepared to have more customized products come in as well.
Sure.
Can I just chip in? Yeah. You know, Ashish brought out an interesting point, and Roshi also spoke about the same thing. I think there's a need for products to be in the market, whether it's an active or passive. In an active fund, the sectors are chosen by the active fund manager. In a passive fund, the decision making for choosing that sector, whether you're bullish or etc., actually shifts either to the distributor, or the customer. And I think that can play a very important role in terms of active versus passive.
Fair enough. Rajiv, you made this point on valuations being higher. Today, are you, and even Roshi made this point, so are you ending up buying stocks that at prices that you would not have bought earlier?
So we have never subscribed to the theory that we need to be fully invested at all times. We have not shied away from being invested in money market instruments, and today cash is at above average levels with us. If we don't find something attractive enough, just because we have an inflow, we don't force ourselves to buy.
Sure. How about you, Roshi? Are you ending up buying stocks higher?
The answer is going to be a bit nuanced. We are running at slightly higher cash levels than we normally would, so that is true. But please remember that even with those slightly higher cash levels, we are still 90% invested. So while 10 may appear on the higher side, there's 90 instead of 95, which is still invested, which tells you that clearly there is an opportunity that we still see for equities. The only nuance that I would say is that the time horizon at this point in time genuinely has to be long term. And while we said that even last year, I reiterated this, you didn't have to be long term last year. I think the 1 year has paid off really well. But
what is long term?
I would still think that today, if the horizon is, let's say in the ballpark of 5 years, you will still make your risk-adjusted spread.
Are you buying stocks higher than you bought earlier? Have you pushed up your valuation threshold?
I have to say, again, when you think about this, this cash level. So I manage the contra fund. And I used to think that having high cash is a nice contrarian bet. But actually, in fact, recently someone published this. The level of cash is high across the industry, which means that everybody is sort of inherently not very comfortable with valuations. Now the problem...
But I think as a percentage of total AUM, it's not radically different. It's probably 1% or something. It's because of the NFO collections.
No, actually, like for example, in contra fund right now, the cash level is like around 13%.
Your fund?
In my fund. So from that perspective, you can say that I've been sort of not so comfortable with valuations. But then there is also this catch, right? 3 years ago, I could put a 20% IRR threshold and find a lot of opportunities. 2 years ago, I could put a high teens, now whether you want to call it 16, 17, whatever, some reasonable range, and look for opportunities, and I got a lot of opportunities. Right now, if I put a higher than 15% IRR, it's extremely difficult to get. But the question sometimes I ask myself is, if the alternatives are all at single digit, should I really be at 16, 17%? Or am I okay even with a slightly lower? No, obviously this is a slippery slope, because once you start sort of going down the slope a bit too much, you end up taking too much risk. But what I've seen is that let's assume a lot of people think cost of equity is around 13%. Right? If you think 13% as the rough sort of hurdle, are there opportunities right now in the market? I think the answer is yes. But are these opportunities the same as what we saw 3 years ago or even 2 years ago? The answer is no. So from that perspective, I feel inherently uncomfortable that I had all these opportunities. They're not there now. But 13% in the grand scheme of things, it's not so bad either, right? So it's like one where I'm obviously moving up the valuation ladder, but am I sort of stretching it so much that I'm talking about now having to justify with a single-digit discount rate and stuff like that? The answer is no.
Ashish, do you think there is also the other risk, because if you just go back 1 or 2 years, and I asked this to a lot of fund managers, and they say, hey, we were sort of somewhat bearish 2 years ago also, and if we had decided to sort of go down to 20, 30, 40% in cash, then we would have underperformed even more. So are we prisoners of the past in terms of thinking about valuations? Because is it possible that this whole liquidity, and right now we are also in an environment where everybody is talking about interest rate cut in the US, if that happens, something that has been in the negative for some time, not negative, but marginally positive in terms of FII flows, that starts to gush in. Is the risk the other side, that valuations could stay elevated for longer time, maybe even higher, so you should be more bullish?
So frankly, as a fund manager, as an investor, I will always want the stocks to be cheaper than where they are today, and want to buy them cheaper when they compared to what they are. I think about cash levels a bit differently. I think, and also Roshi mentioned that increasing the cash level can give you only very slight hedge, right? So maybe you can be instead of 95, 90%. So that does not really materially change your return matrix, etc. Right? So, and the other conceptual challenge I have with cash levels is that are we repeating something 3 times? So cash or being invested in the market is really an asset allocation decision. The investor is doing that. Then his advisor is doing that. And then should I do that again, right? And I think I therefore, and again, all of us are benchmarked investors, so I kind of look at really more in terms of beta, right? So what is the beta of my portfolio? Should it be more aggressive, or should it be more moderate? And really, asset allocation, we focus more on the hybrid funds. And there certainly today, the equity allocation is in some funds 15-20% lower what it was a couple of quarters ago, right? But on the equity funds, we generally don't want to play too much with the cash levels, because I think the asset allocation decision is being made by someone else. Depending on the comfort with valuations, earnings, sectoral mix, etc., we would kind of tinker around with the beta of the portfolio more.
I want to pick on a point that Rajiv talked about, that, promoter selling as an important sign of market speaking out. And this is actually not new. It's been happening for more than a year, perhaps even more now. Dinesh, tell me, how do you look at this? One side of the story is everybody tells me that, unless more equity comes in from promoters, how are we going to get the papers? That's not good enough. So tell me something better.
No, I think first of all, this promoter selling, again, you have to put it into different buckets. There are obviously promoters inherently as a group. They are the most knowledgeable about their companies. So whenever they buy or sell, there is a huge signaling effect, right? And you have to obviously pay heed to that. But then there are these promoters who, for example, when we think about like some of these MNC companies selling, there are these opportunistic MNCs that have just seen the valuations of their subsidiaries skyrocket, and they are looking at the valuation disparity between where they are trading in overseas markets and where the Indian subsidiary is trading, and they want to take advantage of that. And you sort of worry about being sort of like, left with the bag at the end kind of thing, right? But then there are also cases where the parent is in financial trouble, where the parent essentially has a very high debt burden to take care of. So there, they are essentially selling because this is the only thing left that is liquid, and that is something that they can easily sell. There, we want to take advantage of that. So from that perspective, not all promoter blocks can be put in the same category. In general, you have to be careful because they clearly know a lot more about their business than almost any outsider does, right? But when we think about these sort of so-called financially precarious sort of promoters, or promoters where they just need to take care of the debt burden, we'll be very happy taking on some of those blocks, essentially.
But a bunch of it is just selling not only because of debt or MNCs. How do you look at it, Roshi? And I'm also told that in good companies, so-called good businesses and managements. There are fund managers who are actually going to promoters and saying, give us a chunk, we want to buy in. That is also happening. So how do you look at all this?
So I think sometimes perhaps genuinely the promoters also want to diversify, which is not a bad thing maybe, because there's personal equity, capital involved, etc. And you've seen this massive re-rating, and you do want to sort of do what any perhaps prudent investor does, which is that take some money off the table, perhaps put it back in equity markets. And I'm sure there are a lot of distributors here who are helping their promoters do the same. So some of it is perhaps just what any prudent investor would do. I would only say this. In every market, the buyer, it is buyer beware. So you don't have to buy what the other person is offering if you don't like it, and if you feel that valuations are stretched or you don't have visibility of the business. So as long as, and therefore you have mutual funds and fund managers do that job for you. So I think as long as we are just doing our due diligence well, nobody is forcing anything down your throat, I think we'll just make the right decisions for ourselves.
Rajiv, since you started this point, you can have the last word. What do you think? So especially this comment that Roshi is making is very true, that promoters taking money off the table and plowing it back into equity markets. That looks even more ridiculous, that I don't believe in my business, but I believe in all other businesses listed, or whichever business I choose to invest in.
Yeah, so fair point on diversification. So sometimes there's a generational shift. One sibling may not want to be in the business and pursue some other interest. So those kind of needs obviously are there. In some cases, we have seen like private equity funds completely exit. Now, a lot of companies are fully 100% owned by minority or the public shareholders. So in some cases, there have been large strategic sales. So there is some nuance here. You have to go company by company. Yeah, but the point that in some cases, promoters have felt that it's no longer worthwhile running the company at this valuation, and I would rather create a family office out of the assets. Only part of the money comes back to public markets. A lot of it goes into, let's say, commercial real estate or these warehouses or some private investments and things like that. So some people have said it's worthwhile exiting at this price.
Sure, we are running out of time, but I want to ask, some quick questions, Roshi. At this point in time, I think you manage some of the largest funds. Do you wish you were in a smaller fund, managing a smaller fund?
There are pros and cons of both, and it's a discussion that there is no right answer to. The only thing I'd say is this, that a larger fund forces you to be more disciplined. Because the size of positions is such that you just need to be sure of what you're doing, which actually is not such a bad thing, because that discipline pays off in the long term. While in the short term, you may think that size is a barrier and so on and so forth, but the discipline that it inculcates in the fund manager's psyche, I think that genuinely helps in long-term performance. But like I said, there is no conclusive answer to this debate.
What about you, Dinesh?
Oh, I will take a smaller fund any day.
Sorry?
Smaller fund any day. Because when you think about it, right, like
Today or any day?
Any day, actually. Because when you think about it, there are a lot of ideas that are not scalable. These are very good alpha ideas, but they're not scalable. So if I have a large fund, then I won't be able to take part in that. On the other hand, if I have a small fund, I can take part in that. So it really boils down to sort of letting go of a subset of investment ideas that you can otherwise avail of. But the point is well taken, but that often what happens is what you think of as a natural advantage can also come in your way, because if, let's assume, you just throw caution to the wind and you try to do everything because you have a small fund to manage, there can be a rationale that comes with it, which can be a problem. So as long as you take care of that aspect and you have the same discipline regardless of whether you are managing a small fund or a large fund, obviously I will take a small fund any day.
Sure. Sanjay, you wish you had a different job, a sales job right now because a lot of sales bonuses, or are you happy with being in product design?
So I've always been an investment professional for the past 34 years. I love the job. 34 years is my professional thing. Actually, I've been in the market right from my 10th standard. I just love it.
Ashish, you wish you were in sales side now?
So I actually have best of both worlds. I still write, so I think I can have the best of both worlds in this job.
Thank you so much. That's all we have time for. Thanks for being such a patient audience.
All right, let's give a round of warm applause to our panelists for that insightful discussion on the impact of mutual fund flows in today's market. Your expertise has indeed provided a nuanced understanding of the current dynamics as they play out. All right, now coming back to investor expectations. The biggest driver behind investments is optimism. Every investor out there is investing to the best of their ability to create more wealth. Unfortunately, not all of them succeed. There is often a gap between investment returns and investment expectations. And while there is no formula per se, there are some key principles that are core to success as an investor. On that note, I'd like to call upon our next speaker and moderator. This is Nandita Khemka, News Editor Moneycontrol, to moderate this chat. Also, please join me in welcoming on stage Akhil Chaturvedi, Chief Business Officer, Motilal Oswal Financial Services, for a fireside chat.
Thank you, Sonal. Well, I'm delighted to be conducting this very interesting conversation with Akhil here. Last time as well, Akhil and I had a very interesting chat on a different topic. But this time the topic is extremely interesting, is to select the right product that would align the gap between, returns and expectations. Just to, set the context, of course, we've seen a very strong bull run taking shape over the last 5 years, post-COVID especially. But if you look at the last 1 and 2 year returns, they have been extremely strong, right? Just to borrow a quote from a guest on Kaizad's panel earlier this evening, he said that in a bull market, everything seems to get amplified, That also, includes return expectations, right? Given the fact that we've seen such a strong up move, the markets have climbed all the walls of worry. Very recently, the election results, we had the tax tweaks in the budget, we had global volatility, US recession scare, but we have staged a very smart comeback, right? And we're just about 2% away from all-time highs. So going forward, do you think there's a need to firstly temper expectations, at least for the medium term? Do you think the gap between expectations and returns will widen from here?
Yeah, so certainly, given where we are and the kind of returns we have seen in the last 1.5 years or so, it always makes sense to taper down the expectations of returns. But what I hear from all our dear partners is that the moment you try to taper down the returns, investors don't want to hear, right? So they still are, in this awe of seeing higher double-digit returns, and their expectations are very, very big. But yes, I think as rational people from the financial services world, these are the times where I think risk management plays an important role in return management. So at this stage, we have to be, and all the managers have spoken out here in the previous sessions, very important for all of us to assess the risk in the client's portfolio across market cap buckets, thematic funds, sectoral funds. And if at all clients are sitting on a lot of money, then it makes sense to rebalance the portfolio. Remain in equities for long term. It's the best compounding machine. But rebalancing at regular intervals from, kind of euphoric opportunities to somewhere where there is a better value, always will, protect your downside in the event of any kind of risk. The other thing, actually, when I meet all my distribution partners, honestly, on a lighter note, And more distributors are now waiting for the corrections to happen than actually they're waiting for the markets to go up. The only thing is whenever there is a slightest reason for correction, it just gets bought into very fast, because for every 100 rupee which is getting invested today, there is 500 rupee which is waiting to come inside. So you look at the election result day, 8-9% correction bought into. You look at the budget, 8-9% correction bought into. Last week we have seen the yen carry trade and the US economic data, some amount of volatility. And this week is like, every day you are seeing a new high. So we are in a complete different trajectory. But yes, at our level, we need to be more wise and, try and take the best decisions.
So, as I mentioned, the markets have climbed all the walls of worry. What is one big worry, according to you now? Would valuations be a worry?
Yeah, I think through the last 3 years, we've been talking and hearing all about valuations. So valuations definitely is a worry. I think while I'm more on the business side, but I talk to the managers all the time. And I think clearly fund managers really have a task on hand in current times. Whether they have to take cash position or they want to rotate the sector from the ones where, valuations are expensive to coming to more safe havens, which are far and few, honestly. But still, wherever you find relative valuations more comfortable. Honestly, it's a phase where it's not like the buy and hold phase. You have to be on the treadmill, continuously assessing pockets of opportunities, pockets of safety. You have to be very, very agile, very, very active in current times. And then eventually it is all about relative returns, right? So as active managers, we need to do well in good times and we need to do well in bad times. So keeping that in mind, I think, obviously in India, while the macros are doing very well, but micros maybe this year might be a little more somber. From that perspective, your short to medium term return expectation should be lower. But there are a lot of risks which are outside of India than actually within India, right? So if something sparks from outside, whether it is politics or geopolitical or, something happens in US in terms of elections or something like that, I think those are more of the worry factors than actually what is happening here.
Right. So what should the best investment approach be now? Should one be an active investor or a passive investor?
So you should be a mix of active and passive investor. If you're talking about active funds and passive funds?
Active.
Yeah. So investors, I think, like I said, I made a previous point that this is a time where at this stage you need to be a little bit more active. You need to, as investors also, you need to see where your investments have gone in the last 3 years, where you made significant higher returns. And if you talk about small caps and mid caps, clearly we know that you're sitting on very high premiums, and obviously at this stage you need to go more towards safety, and large caps from that perspective is offering that safe haven. So it's good to book your profits where you made a lot of money, move towards large caps, move towards flexi cap funds with higher large cap exposure. I think it is about time where some kind of rebalancing needs to be done, 100%.
And in terms of asset allocation, what should the strategy be? Would you be, an investor in gold? And if yes, which is the best way to invest in gold, especially after the budget, where tax tweaks were announced, right? So would you go for a sovereign gold, fund, or would you go for ETFs, vis-a-vis physical gold?
Yeah, so for many, many decades, we've been taught in our fraternity that gold is something you have to stay away from. Gold is something where you will get inflation plus minus, that kind of returns. But I think over the last 3-4 years, or maybe last 5 years, I think gold plays an important part in terms of asset allocation. Not gold in terms of jewelry, etc., but yes, gold in terms of as an investment product. I think 10% at all times being in gold, and playing between 10 and 20% depending on what kind of a market cycle you are. But gold does play a very important role. Anytime there is a black swan event, there is higher amount of uncertainty, any political event, it does give you a very nice cushion. And these days you are also seeing after the custom duties coming down, etc., there is a demand for gold. You see all the jewelry companies are doing extremely well. So I would suggest that yes, gold should be there irrespective what return is coming out of it. There will be some years where gold will outperform, some years gold will underperform, but you need to have a static allocation between 10 and 20% to gold. The best way to play a gold is if you want to buy physical, buy bricks, that's it, or you buy the ETFs, you buy the sovereign bonds. I would prefer to have sovereign bonds or go for ETFs, or there are index funds also available. And the next best commodity is silver. So you have a combination of gold and silver also available. So those options and those solutions are available, and we should have.
Right. Have debt funds lost their appeal, especially since the indexation benefits have been removed?
Yeah, I mean, clearly the numbers are showing that the debt is completely dead, right? Obviously, the tax thing, post the tax changes, I mean, you're at a marginal rate of tax now. So it's an asset class which typically tends to give you higher single-digit returns, and then you're taxed at the full rate. Obviously, post-tax, post-inflation, what is your real return? And people are smart enough to understand, and I think a large part of that liquidity is also shifted towards equities or hybrid funds or multi-asset funds from that perspective. But for now, the numbers do suggest that fixed income, at least from retail investors' perspective, we don't see too much of flows. Although I think there is a good opportunity coming around to make some money in fixed income as well. But yes, for now, the numbers are not encouraging.
I also want to get in your thoughts on alternative investments, right? Where do they fit in within an investor's overall portfolio, and how should an investor really look at the risk-reward vis-a-vis traditional investment?
Yeah, so that's my favorite subject, right? Talking about alternative, because at Motilal Oswal, we have a pretty large book on the alternate side. Now, for a very long time, we have been the biggest proponents of mutual funds, right? And mutual funds is probably the best vehicle for anybody to invest. But what we have seen in the last 10 years is that as the markets have produced a lot of return, as the country has done well economically, wealth is getting created, there is prosperity. So we have seen that number of billionaires in our country is actually moving up. Number of people who are over 1,000 crores are now running in several thousand numbers. You have over 700,000 people who have a net worth of $1 million and above. So people have made money, and I mean, look at this. I mean, somebody had put 50 lakhs 10 years back, today might be 2.5 crores. 10 years back, 2.5 crores, today would be maybe 7-8 crores, and so on and so forth. So as people have made more money off late, what we have seen is that there is increased appetite to take more risk and look at more asset classes, to get more experience into stuff which is different than your conventional mutual funds. So you look at the numbers, the kind of AUM which is moving up on the private equity side. I mean, the whole category 1, 2, 3, category 1 and 2 AIFs, from nothing in 2012, it's almost 8 lakh crores, 9 lakh crores. And that's all the money which is sitting on VCs, private equity, real estate, right? So there are a lot of people who are putting a lot of money out there. So I feel that those investors who have reasonably large surpluses to invest can take 40-50% exposure to alternate assets. Even on the long-only side, you have different flavors available on portfolio management services, right? You have different flavors on the category 3 AIFs. So your plain vanilla routine products like a large cap, mid cap, multi cap, flexi cap, you can play on the mutual fund side. But a lot of differentiated thematic products can be experienced on the alternate side. So, and I mean, on the debt side also now you have a big opportunity on the private credit space. You can participate to something like fixed income kind of return through the real estate funds on the AIF. You have logistic funds available. You have infra yield funds available. So the whole plethora of options which are available across equities and fixed income, it's really very exciting. So I feel that audience in this room, I think there is a big opportunity outside of mutual funds on the alternate space for your investors who can put that kind of money. But big space.
Right. Akhil, we're running out of time. Just one last question. Globally, tech stocks have been doing phenomenally well, right? Look at NVIDIA. It has had a dream run. For an individual investor, he still has the option of investing in these stocks via brokerages, etc. But for the mutual fund industry to invest in overseas market, there was a limit of $7 billion, which got breached 2 years ago, and the RBI hasn't really come out with or extended that limit yet. Have you guys made any recommendations to the RBI? Would you have a timeline as to when RBI will increase that limit? How are you viewing this entire global tech stock rally and the fact that mutual fund industry is sitting out of it?
Yeah, so on an ongoing basis, we are, we are liaising with government officials, RBI, SEBI, making our recommendations to increase this limit from $7 billion to something $3, $4, $5 billion. Of late, we are seeing again the demand for US coming up. So eagerly waiting, no clarity, honestly, completely clueless. But we are seeing a lot of investors actually using other platforms to buy into the stocks of their own choice. So there are many platforms now available where you can buy stocks. In fact, there are, I think, 1 or 2 funds which have been launched on the GIFT City where you can use the LRS limit and invest into US or emerging markets. But at this stage, obviously, not too much of clarity here.
Right, of course, we'll all wait for the clarity, but of course, I think we are running out of time. We are completely out of time, rather.
Actually, last year also, this was the same issue. The fireside chat has become more like a, what do you say, the fire, what do you call that?
Rapid fire.
Rapid fire.
I don't have a hamper to give you. I'm really
next time I'll take the first spot.
But yeah, it was lovely chatting with you. With that, I would like to hand it over to Sonal to take the evening forward.
Thank you so much.
All right, thank you, Mr. Akhil Chaturvedi, for that fascinating discussion and for helping us understand all the nuances over there that go into creating an effective investment strategy. Now, it's time for a special presentation that we have for you by our knowledge partners, K-Fintech, on the power and promise of technology and how disrupting distribution through tech transformation is imminent. I'd like to invite on stage Mr. G. Till, CFA CAIA Chief Business Development Officer, K-Fintech, to please join us on the stage.
Good evening, ladies and gentlemen. I know it's like fag end of the day, so I would like to keep it a little more crisper than what I anticipated. After this, we have an award function, so eagerly awaited award function. So first of all, I would like to thank Moneycontrol for giving us an opportunity to be a part of this forum as a knowledge partner. And today, we would be showcasing 2 distributor platforms, which is being launched very soon. So when I say like from morning, we have been discussing about mutual funds. So mutual funds, SIPs, investors chasing returns, risk-adjusted returns, various other aspects have been talked about. But as a distributor, what is more important and what is of paramount importance is the portfolio approach. There are multiple asset classes beyond mutual funds like alternates, InvITs, REITs, bonds. You have your exotic products. So how you give a portfolio approach? What is asset allocation? How do you allocate investors' wealth as a part of his overall portfolio? How do you analyze? There is much of correlation between asset classes, cross-correlation between asset classes. So you as a distributor, is there a tool today available for you to provide this analysis? Is something which we have developed as a part of the platform for the distributor fraternity. So and how we have designed this platform is we have segmented into 2 parts. One, there are a set of distributors like banks, wealth managers, you have your single family offices, multi-family offices, where the requirements are completely different. So the analysis is little more in-depth. And there are other set of distributors like the MFDs who are coming from B30, where the requirements in terms of portfolio analysis and the representation to the investors are slightly different. So we have designed 2 different platforms for 2 different segments of distributors. So just before getting into the showcase of the platform, so I would want to highlight 2 things. When you talk about technology transformation, people always misunderstand or misinterpret between 2 things. One is a digital maturity versus digital adoption. When I say digital maturity, today the mutual fund industry is still far behind what insurance or banking was 7-8 years back or what retail was 10 years back. But when it comes to digital adoption, mutual fund industry is far higher. Today, 80% plus of the transactions happen digitally. So transactions are happening digitally, whether this is being brought into the platform when it's being presented to the investors is a question mark. So we are trying to bridge the gap between the digital maturity and the digital adoption which is happening in the industry. Just to throw some highlights, why two different platforms? Today, as we discuss, the whole panel was discussing, there are about 1.5 lakh distributors across the country, including the EOIN holders. Almost 50% of these distributors come from B30 cities. And 26% of the individual investor assets are from B30 cities. And today, no longer the investments happen from top 8 locations. Mutual fund investments are happening across 19,000 pin codes. So how do 1,50,000 distributors reach out to this kind of a market? So definitely technology is going to be a game changer, and there is going to be tectonic shifts in terms of technology adoption. On the other side, the larger distributors, India is the 5th largest in terms of ultra HNI individuals across the globe. And every day 3 ultra HNI individuals are getting added to the kitty. And just to throw an analogy, there are 4 crore demat account holders like about 4 years back. Today we have 16 crore demat account holders. So 4x in the 4 years. So that's the kind of growth the markets are growing. So that's the reason we just came with 2 different platforms. One which will cater to portfolio approach, portfolio attribution, portfolio analytics, whether it's a descriptive analytics or prescriptive analytics or predictive analytics using structured and unstructured data. This is predominantly for the large wealth managers, and the other one for the mid-sized distributors. Maybe we'll just give you a small glimpse of the platform which is getting launched soon.
The financial ecosystem is undergoing significant digital transformation. For 3 decades, KFintech has been at the forefront, pushing past boundaries and reshaping markets, providing modern SaaS-based solutions to over 500 asset and wealth managers worldwide. In this new era, the wealth and asset management industry is also booming. But growth brings complexities, and the need for a Nugent integrated platform to take care of reporting, manual processes, regulations, and serving HNIs. Presenting KFintech's Empower Wealth, a fully automated 360 degrees wealth management platform with hyper-personalization and hyper-scaling capabilities built for global banks, retail and private banks, single and multifamily offices, investment advisors, wealth and portfolio managers, and external asset managers. Empower Wealth is your gateway to the future of wealth management. Key features include integrated omnichannel platform supporting multi-asset classes and currencies, digital onboarding with AML and KYC checks, configurable IPS and risk profiling, compliance and limit monitoring, model portfolio tracking and rebalancing, advanced reports, analytics, and customizable proposal builder, persona-based investor portal and advisor workstation, and portfolio simulation and optimization. Empower Wealth seamlessly connects with third-party interfaces like stock exchanges, data feed providers, execution platforms, custodians, banks, registrars, and more. The platform is database agnostic with API-led microservice architecture, ready for on-premise and cloud implementation. Deliver high-touch and high-tech experience to investors. Automate, innovate, and lead with Empower Wealth. The future is Empower Wealth, and it's powered by KFintech.
So this is the first platform. This is specifically for the large wealth managers and family offices. The other platform, which I mentioned, it's for the MFDs, mid-size, who are servicing retail clients, who doesn't have the capability in terms of analyzing multi-asset classes, having aggregated portfolios, analyzing returns, risk matrices. So we have created a multi-financial supermart where it's not only mutual funds, they can transact, they can view their portfolios across asset classes, including AIF, PMS, bonds, all other products as well. So that product, today, the reason why we are launching that product is, today, like most of the investors, like especially the DIY, most of the younger generation, millennials, are looking at direct investing, directly getting into different portals. There are various mobility platforms. There are various transaction platforms for them to invest. Same thing was disrupted in US also. Betterment, Wealthfront, Charles Schwab. So they created this platform. Today for distributors, there is no single platform, unified platform, which help them in terms of aggregating the portfolios. So that is why we have created a platform called Iris, which will be launched soon. Maybe you can just...
Imagine a world where every financial need is just a tap away. Welcome to Iris, India's first financial super app for distributors. Iris puts the power of the financial world right at your fingertips, whether you're an individual distributor, non-individual, or a sub-broker. Dive into the market with our Fund Explorer. Discover, compare, and choose the best funds with ease. Comprehensive insights, effortless decisions, it's all here. But that's just the beginning. With Iris, you're always connected. Our integrated CRM keeps you in sync with your clients. Track every interaction, manage every portfolio, and never miss an opportunity to cross-sell or upsell. Get insights tailored to your role within the organizational hierarchy. No more guesswork, just the data you need when you need it. And we're not stopping there. We are building AI-driven analytics, personalized financial advice, and more features to take your business to the next level. The future of financial management is here. Experience Iris. Coming soon.
See, these two platforms will help in solving most of the problems for the distributors, and both are enterprise platforms. And this will help in reduction of HNI and retail attrition risk. And today, we all talked about financial alpha. Today, digital alpha is also of paramount importance beyond financial alpha. So we are here to deliver digital alpha for all of you. Thank you. And I would like to thank Moneycontrol team for giving us an opportunity to present this.
All right, thank you, Mr. Senthil, for that presentation. So tonight, as we continue to explore the dynamic landscape of India's mutual fund industry, it's time to turn our attention to those who play an indispensable role in its growth and success, our mutual fund distributors. And very excited to present before all of you tonight, for the first time at our Mutual Fund Summit, Moneycontrol is proud to present the Mutual Fund Distributor Awards. Now, these awards are a tribute to the tireless efforts, innovation, and the excellence demonstrated by distributors who have not only embraced the future, but have also shaped it. So let's get up and give a round sort of applause to our first set of awards. Now, to present our first category, which is SIP Champion, I'd like to first invite on stage Mr. Kailash Kulkarni, CEO, HSBC India Asset Management, and Roshi Jain, Senior Fund Manager, HDFC Asset. Our first award for the evening is the SIP Champion Award, which honors the mutual fund distributor who has successfully registered the highest number of new SIPs in FY 23-24. Now, this award highlights the distributor's exceptional ability to encourage disciplined investing habits among investors, helping them build wealth through consistent and regular contributions. Now, we have 4 zonal awards in this category, and I'm going to start with the North. All right, so the time is now. The winner for the SIP Champion Award for North is Malu Investwise Private Limited. I'd like to call upon Mr. Kamal Kishore Malu to accept the award. categories. The SIP champion for West Zone is Ambition FinServe Private Limited. Please join me in welcoming Mr. Rajesh Kumar Bhutra on stage. All right, so that was category number 1. We're moving on to another very exciting category. Now, the next award is the Youth Investment Champion. This category celebrates the mutual fund distributor who has onboarded the highest number of young investors aged between 18 and 25 in FY 23-24. By engaging with youth, the distributor has played a crucial role in instilling the importance of early and smart investment practices, shaping the financial future for India's next gen. Without any further ado, let me go in to who are the winners tonight. Well, the Youth Investment Champion Award goes to Prabeta Vision LLP. Mr. Shreyansh Kumar, please come on stage and accept the award. Congratulations to all our winners. I'd also like to thank Mr. Kailash and Roshi for joining us and doing the honors. All right, we're moving on to our next category now, and for that, I'd like to invite Mr. Swaroop Mohanty, VC and CEO, Mirai Asset Investment Managers, and Rajiv Thakkar, CIO, Director, PPFAS Mutual Fund, on stage, please. Now, what category are we talking about? We are looking into the Distributor of the Year award. This is presented to the mutual fund distributor who has onboarded the highest number of new investors in FY 23-24. This award recognizes unparalleled reach and impact in expanding the mutual fund investor base, driving financial inclusion and growth. And the award goes to, guesses? Sapien FinServe Private Limited. I'd like to bring upon Amit Bivaikar, Mudit Bansal, Shyam Sinai to please join on stage. Congratulations. Well, moving on to our next category, which is the FinTech Impact Award. Now, this award is presented to the financial technology platform that has opened the highest number of new mutual fund investor accounts in FY 23-24. This recognition underscores the significant contribution of the digital transformation of the mutual fund industry, making investors more accessible and user-friendly. And the winner of the FinTech Impact Award is Asset Plus. And to receive the award, may I please call upon category, which is the National Distributor Award. Now, this award is given to the national distributor who has excelled in onboarding the highest number of new mutual fund investors in FY 23-24, showcasing their extensive reach and effectiveness in broadening the investor community across the nation. And the award goes to Prudent Corporate Advisory Services Limited, Manish Somani and Bhakti Jadhav, please join us on stage. Moving on to another very exciting category. This one we call the B30 Champion Award. Now, this award goes to the mutual fund distributor managing the highest assets under management, AMUs, in AUMs, beg your pardon, in the B30 category region beyond just the top 30 cities for FY 23-24. This award recognizes significant contributions to financial inclusion and growth in emerging markets and also driving prosperity where it is needed the most. The B30 Champions Award for the first ever mutual fund distributor award goes to Sukanta Bhattacharjee. She's unfortunately not here with us tonight, but we congratulate her and we will ensure the award gets to her. Which brings us to the next category now, the Digital Champion Award. Now, this award is given to the mutual fund distributor who has conducted at least 1,000 unique transactions digitally in FY 23-24, recognizing their success in leveraging digital platforms to enhance investor convenience and engagement as well. And the Digital Champion Award goes to the Integrity Money Tree Private Limited, Mr. Rahul Agarwal. Please join us on stage. Congratulations. With that, I'd also like to thank Mr. Swaroop and Mr. Raji for joining us here on stage to do the honors. Moving on to the next few sets of awards, our last prime category, as it were. For the next category, I would like to call upon stage Mr. Vishwanathan Anand back here to do the honors. And we're looking at a very prestigious award category. This one is the Lifetime Achievement Award to be presented to a mutual fund distributor with over 25 years in industry, or spanning 2, 3 or more generations in this case. This award celebrates long-term dedication, influence and significance contributions to the growth and success of the mutual fund industry altogether. The winner of the Lifetime Achievement Award is Gold Star Financial Services. Category, and this is a special one. This is the Nari Shakti Award, celebrating female leadership in finance. This award honors the female distributor managing the highest AUM across all schemes in FY 23-24, recognizing her outstanding achievement and leadership in the mutual fund industry. And to do the honors, we have Vishwanathan Anand on stage, and the award goes to Miss Manju Manskar of the Armstrong Capital. Armstrong Capital and Financial Services Private Limited. All right, with that, we are on to our last, very final award. We present the Bank Accelerator Award, celebrating the retail bank that has opened the highest number of new mutual fund investor accounts in FY 23-24, excluding those sponsored by the bank's AMC. This award highlights the bank's vital role in accelerating mutual fund adoption and financial growth amongst the customers. And finally, the much talked about award, the much talked about winner is, well, it's HDFC Bank, and I'd like to bring upon stage Gunjan Sharma, Ashish Sagar, Rahul Seth, and Mandar. Congratulations to all our winners tonight. And also I'd like to thank Mr. Anand for being with us here on stage and doing the honors. Thanks so much for joining us again, sir. All right, on that very happy note, I would like to take a moment to thank our distinguished panelists, special guests, and each of you in the audience for making this evening truly memorable. Your insights, expertise, and engagement have made this third annual Moneycontrol Mutual Fund Summit a resounding success. We've explored incredible growth potential in India's mutual fund industry, celebrated the achievements of those driving the success, and also delved into thought-provoking discussions as well. Now, the future of investments, they go a long way in empowering Bharat's investors as well. A heartfelt congratulations again to all our award winners tonight for their hard work, vision, and leadership, and the vital ongoing role that they play. Before we end, just a quick reminder and our deepest appreciation to our partners. Well, our presenting partner, ICICI Prudential Mutual Fund, co-presenting partner, Motilal Oswal Mutual Fund, knowledge partner, K FinTech, event partner, HSBC Mutual Fund, and DSP Mutual Fund for their valuable support in making this event possible. Thank you all so much for being with us tonight, and to all the winners, a big, big congratulations. Thank you.